Hello, sports fans, or should I say tax fans? Let's talk about one of my favorite topics, writing a tax memo. Specifically, we're going to focus on factors tests. Now, not all rules in the tax law are black and white like you see here. Many rules apply what's known as a factors tests. Some of these issues deal with whether an activity is a trade or business, or whether a worker is considered an independent contractor or an employee for federal tax purposes. These factors tests, the courts, they take different factors, and different courts, they apply different factors in different ways, different weight. So think about like the weights, the scales of justice. One factor might push it in one direction, another factor might be the opposite end of the spectrum, might push it another way. So we're going to jump in, we're going to look into writing memos, dealing with factors tests, very, very important when it comes to tax profession. All right, with that, let's jump into it. Since we're talking about tax research, it's very, very important that you go back and you watch the video, how to write a tax memo. Even if you're very familiar with the video, it's very important because many of the concepts that you're going to learn in this video, they build off of how to write a tax memo. Think of that video as the baseline for writing tax memos. This video, which deals with factors tests, it adds on to that skill set or that toolbox. All right, let's go ahead. Let's jump into this memo. As you can see, I've already drafted the memo. And the reason why is because if we were to write this together, this is an 8-page memo. This would take us quite a long time. I can't just do this on the actual video with you. So again, that how to write a tax memo video, very, very important to understand format, getting authority, putting that all together in a video that shows you me writing it for you, okay? So we have our typical format, to, from, date, subject, follow that, and then we have our facts. Now, I want to go through the facts, very, very important. I'm going to note that in the facts, you're going to see there's a lot of crucial dates. Year 1, year 2, year 3, year 4, year 5, year 0, year -1, year -2. Now, I don't think there's a crazy amount of facts compared to what I've seen in practice. However, if you're a little lost, it might help to kind of create like a timetable of specific dates where, okay, here is the first event that we see, January 1st, year 1. I always leave some space just in case you need to go backwards in time, because in tax, a lot of things in the past can affect how a taxpayer is treated for a certain transaction, so always keep that in mind. I'm just going to throw that out there. That's a very good strategy, whether you're writing a memo and you're trying to understand the facts, whether a client is giving you facts, because remember, when you're doing a fact section like this, and I've already drafted it for you, you want to make it chronological. You want to put all the facts given in order. And finally, even if you're just taking an exam, whether it's a CPA exam, whether it's a law exam, an accounting exam, whether it's the bar exam, and you've got to do a write-up for a specific problem that you're given, it helps sometimes to just think through the facts, and a timetable can really help that. Okay, so January 1st, year 1, we have a Florida land developer, Calvin Klein, purchased a 500-acre parcel of land in Florida for $1 million. So dates, even if you're not sure about a specific issue in tax, we don't know anything yet. We don't know anything yet about this issue. We haven't looked at the issue yet. We're focusing just on the facts. But dates, purchase amounts, because of basis, information about property, jurisdiction, so Florida, those types of things are very, very important when it comes to facts. December of year 1, so still in year 1, Calvin spent $200,000 installing sewer water lines and subdividing the land into 300 quarter-acre parcel home sites. Now note that this is not meant to add up to 500 acres. So yes, Calvin did purchase a 500-acre parcel of land in Florida, and he went through subdividing and installing sewer water lines, all these things, and ended up having 300 quarter-acre parcel home sites. The reason why 300 quarter acres does not equal 500 acres is because a lot of that space was devoted to streets, public space, things like that. Maybe shopping areas, residential areas, things like that, okay? So for the next 2 years, again, dates are very important. So next 2 years, Calvin devoted his efforts to developing other parcels of land and selling them. Not the 500-acre parcel in Florida, but other parcels. He averaged 10 lot sales per year for years 1 and 2. And these, again, are not part of the 500-acre parcel. And averaged 10 lot sales per year for the 3 years before year 1. So year 0, year -1, and year -2. So the 3 years before year 1. In January of year 3, Calvin sold 100 of the home sites for $1 million. So purchases and sales, the dates of purchases and sales, always extremely important in tax. So always note those. To a builder in one transaction. Now, Calvin received $1 million selling those 100 home sites to a builder. But Calvin's total income that year was $1.5 million. And there's no other income activity. So what I'm saying is that $1 million of this $1.5 million comes from the January year 3 sale of the 100 home sites. The other $500,000 comes from something other than the 500 acre parcel, or the 300, at this point it's now a 300 quarter acre parcel, I should say. Okay? Because again, Calvin deals with other development activities. Calvin then held off selling the remaining 200, so there's 200 left, right? We have 300 quarter acre parcels, 100 of them are sold in January year 3, so there's 200 left. He holds off selling the remaining 200 because he's speculating that a major future increase in value as there was a sudden economic boom in the area. In years 4 and 5, Calvin engages in developing apartment complexes for Capital City Construction Corporation, also known as 4C. December year 5, 4C made Calvin an unsolicited offer and purchased, so we have a sale by Calvin, the remaining 200 home sites from Calvin for $5 million. And they're going to construct a large apartment complex on those sites. Now, Calvin received $5 million that year from this transaction, this sale of the 200 home sites, but received $7 million total in total proceeds. Again, that's including the $5 million, but then there's other activity as well. And then that's all Calvin received in terms of income for the year, no other activity. So those are the facts. Again, if you're not really too sure, go back, draw a timeline. Now we have to jump in. And the issue is, what is the character of Calvin's gain, if any, year 3 and year 5 sales? So let's go back to our facts and let's just point out these specific year 3 and year 5 sales because that's what we're asked about. We're asked about these two sales, year 3 and year 5. So the first sale happens here. On January year 3, Calvin sold 100 of the home sites for $1 million. That is number one. That's number one at issue. Number two at issue is December of year 5. 4C made an unsolicited offer and purchased from Calvin the remaining 200 home sites for $5 million. And that is number 2. So those are the two transactions at issue here, two dispositions at issue. And we have to determine if there's any gain, and if there is gain, we need to calculate it. And we also need to determine characterization. Now, anytime you have a property transaction in tax, there's a specific set of rules that you are going to follow. And this video and this memo is going to be very, very helpful for you because the way that we start off the memo, this is always how you're going to start off a memo in a property transaction. So property tax, property transaction. Let me rewrite that whole thing. Property transaction, again, what we're dealing with, anytime that you have a purchase, sale of property, and property is defined broadly under the tax law through cases, but property transactions, anytime you have a sale or other disposition of property, then you have to worry about the property transaction rules. And I have some substantive videos out there. So tax research, as you know, is more about learning how to learn the tax research process. Substantive tax rules are actually the tax rules that apply to the tax law. But I have some substantive tax rule videos out there that deal with property transactions. Now, the first property transaction rule you always consider is section 1001, and that is the realized gain calculation. So the gain or loss, but here we're asked only about the gain, so I put gain. The gain from the sale or other disposition of property is the amount realized minus the adjusted basis. So it's just a formula. Amount realized minus adjusted basis. And that is always where you start when it comes to property transactions. So whether you're dealing with calculation of gain or loss, so calculating gain or loss, whether you're determining whether the gain or loss is recognized, and I'll talk about that in a little bit more detail later, or you're determining the character, you always should start off with the gateway rule of section 1001. And you should state the gain from the sale or other disposition, the gain or loss from the sale or other disposition of property is the amount realized minus the adjusted basis, and that gives us the realized gain or loss. Now, some of you are wondering, you say the gain or loss. Why are you just saying the gain? Well, the issue is just focusing on gain, and it's pretty easy to see why it's gain in the facts. Think about it. Even if you're not a tax person, you purchase 500-acre parcel for $1 million. You spend $200,000 adding some things to it, subdividing it, installing sewer water lines. You've invested $1.2 million. You're going to sell all of that land, those parcels, for $1 million in year 3 and $5 million. So $6 million total. Just thinking about economically, do you have a gain? Yes, you do. You got $6 million for something that you purchased for $1.2 million. You purchased for $1 million, you added $200,000 of extra value. So anyone could tell you that there's going to be a gain there. So that's the reason why we have gain, and it happens to be that you're going to see the way we calculate it, there is gain indeed. All right. So it would be the gain or loss normally from the sale or other disposition of property is the amount realized minus the adjusted basis, and that would give us the realized gain or loss. Of course, this is a formula. We've got amount realized, adjusted basis. We're going to go in order. First, we're going to start off by defining the amount realized. And again, if you're doing a property transaction memo in the future, you want to start off this way. As you learned in the how to write a tax memo video, right? Very important video. You learn that you always start off with the Internal Revenue Code if Internal Revenue Code sections apply. So we're starting with the section 1001, the formula, amount realized minus adjusted basis. Then we're going into the code and we're defining these terms, amount realized, adjusted basis. So let's first start by defining amount realized. Amount realized is defined, and it's defined as the sum of any money received plus the fair market value of the property other than money received. Now, this is referenced in section 1001B. So now we can kind of go into the facts. In year 3, right, our first transaction, January year 3, Calvin sells 100 parcels of land for $1 million total. That's what he sold it for. We're told in the facts $1 million. He received no other property in this transaction, so his amount realized for year 3, the two dispositions at issue, is $1 million. So we're just focusing on the 500-acre parcel, the 300 quarter acres. We're not looking, yes, he has other income during years 3 and 5, but we're only focusing on the activities related to the 300 quarter acre parcel in this fact pattern. Year 5, Calvin sells his remaining parcels, the 200 remaining ones, of land for $5 million total. He received no other property, so his amount realized for the year for year 5 is $5 million. So we've just calculated the amount realized, boom, that's the first part for these two transactions. So after determining the amount realized, what's next? Follow the steps logically. We then go to the adjusted basis. And again, I have a video on all these concepts. Calculating realized gain or loss, calculating amount realized, calculating adjusted basis. I have a video on all of these things in case you want to go back and you want to review those things. But again, we're focusing on tax research, the structure, how you phrase these things. Again, if you're doing a property transaction memo, you're going to start off like this. So after amount realized, for the year 3 and year 5 sales determined, which we did, the next step is to determine the adjusted basis for these transactions. So Calvin's original basis in the 500 acres, which is the 300 quarter acres, is the $1 million purchase price. The $1 million original basis is then increased by $200,000 for the installation of the sewer and water lines, resulting in an adjusted basis of $1.2 million. Now, I actually left out a citation here that I recommend you put in. See, adding a little bit of value. It's not just in the memo, we're adding. So it says, Calvin's original basis in the 500 acres is the $1 million purchase price. That would be under IRC section 1012, which is the cost basis principle. The cost basis principle says that if you purchase a computer for $1,000, if you purchase a folder for $10, that is the basis. $10 for the folder, that's what you paid. $1,000 for the computer. Well, here, Calvin paid $1 million for a 500-acre parcel. His basis, unadjusted basis starting out, or his initial basis, we call it, original basis, is $1 million. Now, the original basis is then increased by any additions or to the property, which is the $200,000, and that then brings his basis from $1 million to $1.2 million, and that adjustment code section is section 1016, 1A. Now, we've got an issue though, because we're selling the property, the 300 acres, in 2 dates. 2 dates. It's not all the same tax year. If it was the same tax year, we could just use the basis and we could total everything up. But it's year 3 and year 5. So the idea is that we're going to need to prorate or apportion the basis somehow. So when a part of a larger property is sold, the costs or other basis of the entire property shall be equitably apportioned. Let me get my highlighter there, my apologies. Equitably apportioned among the several parts. So it's saying, hey, year 3 we've got a transaction, year 5 we need to break up that $1.2 million total basis. And Reg 1.61, my apologies, -6A is where we find that. Now under the regulation, Calvin must allocate the $1.2 million total adjusted basis equally, and by equally I don't mean split it between 2, equally across the 300 acre parcel because it was all acquired at the same time. So I'm saying per acre. So if there's 300 acres, you would take 1.2 million, okay, divide that by 300 and you would get the per acre amount. And again, that's cited back to that regulation. Another way to do it is just to take 1/3 and 2/3, right? In year 3, 1/3 or 100 over 300 total acres is sold. So we're going to allocate 1/3 of 1.2 million basis to the year 3 transaction, and 2/3 or 200 acres over 300 to the year 5 transaction. So that's what's going to go to the adjusted basis. So we're taking, and I show the calculation, the amount on the next page, but you're going to take 1/3, 100 over 300, 300 total, right? We're selling 100 in year 3 over 300 total times 1.2 million. Remember, that's the basis that we calculated. Remember, we determined that the basis is 1.2 million. So we're going to be multiplying 100 over 300 times 1.2 million, and then 200 over 300 times 1.2 million, and that's going to get us our basis. So here's the basis, $400,000 for year 3, $800,000 for year 5. And as you can see, if you were to check your work, those two add up to 1.2 million, so we know that we've allocated that out properly. So using the formula, by formula we're talking about the amount realized minus adjusted basis formula. Calvin's realized gain for year 3 and year 5 that should be $600,000. So let me change that to $600,000 and $4.2 million respectively. So $600,000 in year 3, which is the $1 million received minus the $400,000 basis allocated, and then $4.2 million in year 5, which is the $5 million received minus the $800,000 basis allocated. So again, $600,000 realized gain. Realized gain is key. We're going to talk about recognized gain in a moment. That's the next step. $600,000 in year 3, $4.2 million in year 5. So the next step, after you calculate the realized gain or loss, and notice that again, we're citing all code sections, which you still need to do when you're doing a tax research memo. The next step is to talk about non-recognition. So the idea is you calculate the realized gain or loss. The next step is you determine if it's recognized. Recognized is what goes in the tax return, ultimately. It might be offset by losses, but at least goes on tax return. If it's not recognized, it doesn't go to the tax return. So unless the non-recognition rule applies, the realized gain or loss shall be recognized, and that's under section 1001C. There are no non-recognition rules that apply here. And the reason why is because Calvin is selling property for cash. When you sell property for cash, there's no chance that a non-recognition rule is going to apply. So if you're selling property for cash, there's no chance that you're going to get a non-recognition rule. Just keep that in mind anytime you're selling property for cash. Because if you think about the non-recognition rules, and again, I have videos on this, it goes against the themes. The theme of liquidity, you have the cash to pay the tax. You've just got all cash. So if you just have all cash, there's no, Congress doesn't thinks that it is right for you to get taxed. It's a change in economic events as well. So those amounts, $600,000 in year 3, $4.2 million in year 5, they will be recognized as well. They will be recognized and reported on the tax return unless there's some type of loss offset or something. So once we determine the recognized gain, the next step is to determine the character of the gain. Now, there's really 2 different options ultimately when it comes to tax. Ordinary and capital. Capital can be broken into long-term capital or short-term capital, which If we go through the analysis and we determine that it is indeed capital, we can then make that determination if it's long-term or short-term later on. But if it's ordinary, ordinary is not broken into long-term and short-term, so it makes no difference. So I'm saying is that why don't we just go through and make sure something is ordinary or make sure something is capital first, then we can do that step logically next to save us time and not worry about that. So ordinary income is defined, again, lots of definitions, as any gain from the sale or exchange of property which is neither a capital asset, which is neither a capital asset nor property described in section 1231. So what it's saying is that it's either a sale or exchange of a capital asset, which is the general capital gain or loss rule, or a section 1231 transaction. Now there are some other transactions found in the 1230s, 1240s, 1250s, and so on in the 1200s that you could have ordinary treatment and makes it capital, like a patent or something that normally, like a self-created patent, it would be considered ordinary, but as a special rule. There is one special rule we're going to talk about at the end of this memo, and I'll talk about that, but I will tell you that there's none that apply except one special one that we're going to talk about later on. So just keep that in mind, but those are really the two ones here, okay? Now, I could have made that more clear in the memo, but the idea is that you want to just put the general concept here, and then you want to add those exceptions later on that you considered them, which I do show you. So that's section 64, defines ordinary income. Basically ordinary is, hey, everything other than capital gain and 1231. That's really what it's saying. Now section 1222 is where you find that general definition of capital gain, which is a sale or exchange of a capital asset. I cited section 1222. So you're basically reinforcing section 64 goes about it from the other side of the coin. It says, hey, if it's not tails, it's heads. And then section 1222 says, hey, if it's heads, it's heads. Right? Heads being capital, okay? Or I should say, my apologies, that analogy, I should say, if it's not tails, it's heads, heads being the ordinary. And then if you go 1222, it's saying, hey, if it's tails, it's tails. Okay? Basically, ordinary is everything other than capital and 1231 is what it's trying to say. And the reason, again, why ultimate character is between ordinary capital is that many of you know section 1231, after you do the netting and the sub-hodgepodge, it ultimately ends up being either ordinary or long-term capital. So again, capital or ordinary. If you're unsure why that's the case, please watch my video about section 1231. I explain it in under 10 minutes. Okay, so now we go into some of the facts here. The facts state that Calvin sold the land. So the sale or exchange requirement is not that pertinent. You can really see that under section 64 and section 1222, you need a sale or exchange of a capital asset or 1231. So the capital asset is met, okay? So really the issue that in determining the character comes down to whether it's a capital asset or a section 1231B piece of property. So first, let's start with section 1231B. Section 1231B is where you find section 1231 property. And the idea there is this is not considered section 1231B property used in trade or business. That type of property is property that a taxpayer would use in generating revenue, not like what they're actually selling to generate revenue. So think about like a building that a retailer has, right? They're using those facilities to do their key things, but it's not the subject per se of where the sales come from. Now, a retailer might end up selling a building, but that's not a usual transaction. So things like that. Equipment used to produce or manufacture goods. The idea is that you're selling the goods, the equipment helps you get there. Here, though, the land is what's being sold. It's like the end idea. I don't want to use the term inventory because you're going to see that we're going to talk about whether this is inventory or not in a moment, okay? So that's why it's not section 1231B property, because it's not property used in trade or business. And I put the reference to section 1231. So if the land being sold, and that's the 300 quarter acre parcels, if it's not a capital asset, then it's going to be ordinary income. So basically, what we're doing here, and this is very, very important to understand, we are taking these rules, right, these conditions. Under section 64, you know that it has to be sale or exchange, which we have, and you need a capital asset or 1231B. You need both conditions. You need both. Well, we have number one, but number 2 is the issue. Same with section 1222. That's the issue. We have a sale or exchange, but the second requirement, you need both of these. If you fail either one, requirement 1 or 2 of section 64 or section 1222, you are going to have ordinary. So if we fail this, if we fail number 2, we're going to be ordinary. We have to meet both of these. We have to meet 1 and 2. If we meet 1 and 2, then it's considered capital. And then we determine if it's long-term or short-term. That's the order of things. So it's kind of like a logical reasoning approach. We're getting down to what the real issue is. The real issue here is whether it's a capital asset, because under section 64, it can be a 1231B or a capital asset, either of those. We know it can't be 1231B, so our last choice, our last stand is determining if it's a capital asset. So if the land is not a capital asset, it will be ordinary income. And you have to structure your argument this way. Even if you think the person reading this, oh yeah, they're a shareholder, they know this, you still structure it. You show them your reasoning. You want to show them you have sound reasoning. And that's the idea. That's the idea behind tax research. It's not simply just to state some, give some summary. It's also to show your reasoning so that you can get the audience to understand where you're coming from to make arguments, because a lot of times you might not have cases or authority that supports your claim, so at least you can try to reason through. And you're going to see that's going to be the case when we get closer to the end here. So again, it's all about showing your reason, your structure. Very, very crucial. If you're in my tax research class and how I teach it, I'm all about structure. How are you getting to your argument? You can't skip steps. You can't skip assumptions. You can't just go right from, okay, we know we've got a $600,000 gain in year 3 and a $4.2 million gain in year 5. You can't just go down and say, oh, well, we need to determine if it's a capital asset or 1231 asset, and that will make the difference. So you guys show me the steps. You guys show me the conditions. You guys show me, okay, we met the sale or exchange requirement, boom. So then we go on to capital asset or section 1231. Can't be section 1231, so the only thing left is capital asset. And that's where we're at now. That is where we're at. We're trying to determine if the land being sold in years 3 or 5, the parcels, are considered a capital asset or not. So a capital asset, this is one of my favorite code sections of all time. A capital asset is defined as any property held by the taxpayer, whether or not connected with business. So it could be a personal asset, could be your personal home, could be investment asset, could be investment property, could be an investment, rental house. So it's any asset. Doesn't matter what the activity is. It could be personal use or personal activity, could be investment, could be business, but it does not include a list of exceptions found in section 1221. So this is why it's one of my favorite code sections. It basically says, hey, everything's a capital asset other than these. And those are found in section 1221A. So if you go through that list, and if you want to stop the video, go take a look. Go look at section 1221A and look at the different exceptions. Now, going through that list, you're going to see that there's only one possible exception, because remember, we eliminated the property used in trade or business. We already talked about that, and that makes up a group, and then everything else is things like accounts receivable and intellectual property and hedging transactions and government publications and none of that stuff. So we eliminated the property used in trade or business earlier, and that's actually one of the items in the list. Okay, that's why 1231 is needed. So we are going now, there's one exception that might apply in the list. So what we're saying is we're trying to determine for capital asset. We are a capital asset if we don't meet any exceptions, but there's one exception that could apply, and that exception is as follows. Stock in trade of the taxpayer or other property of a kind which would properly be included in the inventory of the taxpayer if on hand at the close of the taxable year, or property held by the taxpayer primarily for sale to customers in the ordinary course of his trade or business, which I'm going to refer to for the rest of the presentation, rest of this video, rest of the memo, as primarily for sale to customers in a trade or business. So what is this? This is inventory or property that's held by the taxpayer primarily for sale to customers in a trade or business. If you think about it, if you're a land developer like Calvin, then this could be property that's normally what you sell to your customers. You sell land, you sell parcels of land. However, if you go back to the facts, and if you want to pause the video and go back, you will see that in the facts, there are some instances where it seems more like maybe he's not doing what he normally does as a developer. Maybe he's speculating on value, and that seems more like an investment, right? Like when you purchase a stock, maybe one of your favorite corporations, and because you think that's going to increase in value, you're speculating that the value is going to go up. That's an investment type activity. I mean, unless you're a dealer or trader in securities, which is almost surely not the case, especially if you're an individual doing this, right? So the idea is that there's arguments that it may be primarily for sale to customers in his trade or business. It might not be. He's normally a developer of land, so it seems like it likely would be, but we're going to find below that that's not always the case. It's not always the case that a taxpayer, that they, just because they're a developer, any land that they touch, right? It's like they have the Midas touch or whatever. They touch anything and it turns to gold or whatever, and then it becomes an issue, right? Think of it like that analogy, the Midas touch, where somebody wants to be able to touch anything and turn it to gold, and then you touch everything like food and it becomes an issue. So just because you're a developer and you touch land or you hold land, does that automatically make it inventory and taint it to where everything becomes ordinary to you? Which, as you know, we generally want long-term capital gains if we have gain, not ordinary gain, generally speaking. There's some exceptions, but rare cases. But almost always we want long-term capital gain because of preferential rates. So the idea is, well, it's not the Midas touch. It's not everything. There are going to be times where if you're a developer, you can still hold property as investment. We're going to see that later on. So as we go on, let's continue reading. So whether the land is a capital asset, which result in capital gain. So if we determine that the land is a capital asset, which specifically I mean that it's not considered primarily for sale to customers in a trade business, because remember, the definition of capital asset is any asset other than the exceptions, and one of the exceptions deals with primarily for sale to customers in a trade or business. So we're trying to say, if it is, we're trying to establish that if it is, then it's not a capital asset, it'll be ordinary. But if it's not this exception, then it's considered a capital asset, and it will be treated as a capital gain. And then again, we determine if it's long-term or short-term. Okay, so the analysis will be whether the land is capital assets, the exception is not met, or the exception primarily for sale to customers in a trade or business is met and it's not a capital asset resulting in ordinary income to Calvin. So to meet the requirement of primarily for sale to customers in a trade or business, as it's broken down, it's really broken into two conditions. First one being primarily for sale to customers, and second one being in a trade or business. So first, let's talk about the easy one that's met. First, Calvin is clearly engaged in a trade or business. If you look at the facts, he's a developer. Throughout the years, in the past, he's been making lot sales, right? He's been selling average 10 lots per year. Years 4 and 5, he's selling. He's helping this apartment complex doing development. He's a developer. That's his main business, his main bread and butter business. He's in the trade or business of developing property. So he's clearly engaged in the trade or business of being a developer, of purchasing land and its sale. So there's no disputing that. That is clear. Okay? More likely than not, that is the case. We don't even need to go into the analysis there because that is clear from the facts. Now, if you want to go into the analysis and find a case that's similar, you can do that, but that is very clear. His development activities with respect to the 500-acre parcel alone should be sufficient. You could even argue under, Commissioner versus Grotzinger, which is the Supreme Court, one of the main cases of defining a trade or business, just the activities alone of subdividing it and installing utilities. Even if he generally wasn't in the trade or business of land, he could potentially be in it just for that. But it's even clearer because he's got past transactions. He's doing it on the side. He's doing other transactions beyond this. So the trade or business condition is met. So we've only got one part left. And that other part, which is what the rest of this memo is going to focus on, deals with the condition of primarily for sale to customers. Okay? So in a trade or business, condition of primarily for sale to customers in a trade or business is met. The next step and final step, so if we prove this, if we prove primarily for sale to customers, that portion, then the exception applies and it's going to be treated as ordinary gain. But if we fail this primarily for sale to customers, then the exception is not going to apply and it's going to be capital, okay? So we're going to be focusing on this primarily for sale to customers aspect, okay? As he originally intended, or whether he has changed his purpose to investment by diverting his efforts to other properties. Because remember, we're told that after the year 3 transaction, and also in year 1 and year 2, we're told that there was some divertment of activities. Year 1 and year 2, he switched over to other sales of lots. In year 3, he made his first transaction. But then year 4 and year 5, he was working with 4C, right? With 4C in terms of the apartment complexes on other projects, not his 500-acre, 300-quarter-acre parcel, okay? Not that. So that's what the issue is here, okay? If you're still having trouble understanding that there's a potential investment issue here, is go back to the facts. You will see that from the facts, he's doing all these different activities, just like a developer would. They've got their hands, in different places. They're diversifying their activities because maybe some development activities are a bust and others are going to be, striking gold. And that's the idea here, is that, he's working over here in this 300-quarter acre. He does a little bit of work. Year 1, he did a bunch of work, but then year 2, he didn't do anything. He went and worked on other stuff. Year 3 comes around, and now he's selling that property, which is what developers do, right, to a builder. And then he doesn't do anything with it because he's speculating on the value. That seems more like an investor. And then it comes around and he gets an unsolicited offer from the apartment complex 4C, right, that corporation, and he sells for a very large amount because the value did go up. So he did speculate, and he was correct. It did go up in value because of the economic boom. Now, Supreme Court case, Mallet versus Riddle, primarily for sale to customers, means that his principal reason, Calvin's principal reason for holding the property must be to sell it rather than keep it as an investment. So if the principal reason is to sell it, but not hold it to keep it as an investment, then it will meet primarily for sale to customers. So what we're trying to say is that you can still be speculating, but if you're still trying to sell it like you normally do as a developer, then that isn't, just because you're speculating, that doesn't make it and become an investment. You got to be very careful. Now, the court in Mallet indicated that the purpose of the capital asset definition is to distinguish ordinary business profits. So we're trying to distinguish ordinary business profits, so it's normally done, from the realization and value accrued over a substantial period of time, over a big, long period of time. Now, you can argue that 5 years, right, that's the second sale, that's holding property for quite a while, especially for a developer. However, the first transaction didn't occur until year 3, so that might have been due to other reasons. So we're going to see those types of issues popping up, and what you're really going to see is that we have to really focus on the facts of other cases and other authority that has facts in it to compare and contrast what's going on to our situation for Calvin. So dealers or developers improperly are sometimes successful in treating properly normally characterized as primarily for sale to customers as being held for investment. So this is very good for Calvin. Calvin wants capital gain, doesn't want ordinary income, generally speaking. Okay, Calvin wants capital gain because of lower rates, especially if we can get long-term capital gain. All right, which is likely here because Calvin purchased it in year 1, he sold it in years 3 and 5. So it's possible, just because you're a developer in property like Calvin, you can still sell land and it be considered an investment. It's not the Midas touch. Not everything you touch is going to turn into gold. So don't think that it's this taint that automatically, because you're a developer, anything to do with land is considered sales of ordinary, like inventory. Can have, again, investment. That's very important. All right. The determination, and this is very, very important. This is where we get into our factors analysis, which is the highlight of this video. So far, I've walked you through kind of the same structure of what you learned in the How to Write a Tax Memo video. The only difference is that in that video, I focused on deductions. This is another one of the 5 questions, the 5 general questions. We're talking about calculation of gain or loss, the 5 income tax questions, right? What amount of income, what amount of deduction or credit, when do we have income deduction credit, who gets the income deduction credit, and the final one is character. So now we're talking about characterization. So far, same structure of the memo. You want to logically set things up, but you're also getting to see how things are set up for a property transaction and a characterization memo. You can use that, okay? You can use that. And by the way, I want to again stress that if you are doing a memo in property transactions, whether it's a realized gain or loss calculation, whether it's a recognition, a gain or loss, whether it's recognized or not, like a Section 1031 like-kind exchange, or a Section 1033 involuntary conversion, or Section 351 corporate formation, something like that. Or if you're doing a characterization, you're going to start off your memo with all those steps. You're going to start off going through the realized gain or loss under Section 1001, amount realized adjusted basis. Then you're going to say, okay, all realized gains and losses are recognized under 1001C unless there's a non-recognition rule. Then you got to find a non-recognition rule. We didn't find one, so we moved on to characterization. Once you go into characterization, you start off and you say ordinary and capital, the two ultimate characterizations, just like we did in the memo. Then you break it down. You say Section 64, Section 1222. You go through those elements just like we did. That's going to be your structure for a property transaction memo. That's what you're going to do. There's not going to be much change with respect to that. There might be change in the sense that you might have more focus on a recognition issue, like if you're dealing with a like-kind exchange. Of course, when you get to the recognition aspect, you're going to need to go into Section 1031 in great detail. So this determination comes down to several factors that courts have considered. What does that mean? We've got a factors test. Now remember, factors test, as I said at the beginning of this video, it's not black and white. It's not bright line. It's not, oh, if you have more than 35 hours or 500 hours or this or that, you meet the criteria. No, it's a weighing scale. Think about the scales of justice. There's two outcomes. We have on one side, we're going to have ordinary. On the other side, we're going to have capital. And based on various factors, we're going to answer questions. And that question might move us from one side of the scale to the other. And the idea is that it's not simply just, okay, we look at the majority, and if you have a majority of factors, you win. Some factors are stronger than others, and depending on the facts and circumstances, those stronger factors can be weaker in other cases because the way that different courts look at the factors, the way that different situations affect the factors, different industries, there's so many different aspects of it. Factors tests are real challenging. They're one of the most difficult things in the tax law. That's why I'm focusing on this video. And what you're about to see is going to help you really understand what goes on. And also what I think is the best way when you're writing a factors memo, because articulating factors tests in a memo is very difficult, and it helps if you can try to help the reader visualize what you're trying to explain. This is where tax research becomes more of an art than a science, because you're not in the brain or the mind of the judge that's going to make the decision, or the jury, if it's a jury trial, like in a federal district court, that makes a decision about whether something is considered ordinary or capital in a specific fact pattern given. You're not in their mind, okay? So you have to use different reasoning techniques, and we're going to talk about those, to make just educated ideas and explain how the factors are influenced. And if you start to see, okay, well, now we got patterns emerging, then it makes more sense and you have support for that, it makes more sense to say that, okay, well, this results in ordinary, this results in capital. That's the idea. Okay, so now we're going into the factors. Right here, we're starting out, we're going into our factors. So now, very important, again, don't think bright line here. Okay, don't think bright line. You got to think factors. So if you don't meet a factor, doesn't mean that you lose or win a specific what you want, right? You could make up with another factor, or you might get all the others, you might miss all the others. So again, it's a whole package. Let's go ahead now and let's talk about these things. And we're going to go very slow through this because this is very important. If you have to pause the video to think about something, read it, please do that. I want you to do that. All right. So first thing, when it comes to factors tests, just like anything when it comes to tax, you got to look to the circuit. There's something called the Golson rule. In the Golson rule, and it doesn't matter whether you're in a tax court or you're dealing with a jurisdictional issue in your district court or U.S. Court of Claims, the Golson rule basically says that the tax courts have to look at the circuits. But if you're dealing with the U.S. Court of Claims or your federal district court, which those are the three different courts of original jurisdiction for tax cases, you're going to have to follow the circuit anyways. The Golson rule says that tax court, which is a national court around the entire U.S., because they're riding, they ride all over the country, they hear cases all over the place, they have to look to the circuit that they're in. So if they're in Texas, they would be looking to the Fifth Circuit. If they're in Florida, they're going to be looking at the 11th Circuit. If they're in California, looking to the 9th Circuit. They're in New York, looking to the 2nd Circuit. Okay? It's not just, oh, we go by any other tax court case. We go by any other tax court case. Now, they are bound by tax court cases. That is precedent. But specifically within the same circuit. Okay? If there's nothing in the same circuit, then you can look to tax court cases outside. So basically, you have to look for circuit court decisions or tax court cases that happen in the same circuit. That's what we need to focus on. So because Calvin resides and conducts this activity in Florida, he's in the 11th Circuit. Now, something really important about the 11th Circuit, and the reason why I'm highlighting this is because when you do research on this issue of developers and whether the dispositions of real property are considered ordinary or capital, you're going to find that some of the law, it's older than the 1980s, maybe 1960s, 1970s. This was happening a lot back then because the tax rates were so high. See my introduction to U.S. tax law video where I talk about the history of the U.S. income tax and how between after World War II and, I should say during World War II and all the way up until beginning 1980, tax rates were as high as 90, 95, 94, 96% in some years, 90%, 80%. So there were a lot of tax cases that happened. And back then, if you're an ordinary income bracket of 90%, but long-term capital gain of 28%, this made a huge difference. All right. So the 11th Circuit, which is where Calvin resides in Florida, it was created in 1981. Now, there's a case, Bonner versus the city of Pritchard. It basically says that, hey, the 11th Circuit adopts all 5th Circuit cases before October 1st, 1981, because again, that's when it was created, because 11th Circuit, which is Alabama, Florida, and Georgia, used to be part of the 5th Circuit. Now, of course, if there's a 5th Circuit case that's been overruled, that makes a difference, okay? Or it's been superseded or whatnot, distinguished, those things are important. But we're saying if it's still good law in the 5th Circuit and it was issued, the court ruled prior to October 1st, 1981, then it's binding on the 11th Circuit. All right, that's very important. So when we consider the applicable law, we also need to look at the 5th Circuit before October 1981. Now, you generally want to make sure that you look at cases that are newer, and we do have some cases that are newer, but you're going to see that some of the most important cases are older. Okay, so there's 2 cases in particular I'm going to mention that come from the 5th Circuit that are before 1981, and they're very, very, very important cases. So the Court of Appeals, here's one of them. The Court of Appeals in the 5th Circuit held that there's 3 principal questions to be considered in deciding whether gain is capital or ordinary in the developer situations. These 3 questions are, was the taxpayer engaged in a trade or business, and if so, what business? Was the taxpayer holding the property primarily for sale and business? And were the sales contemplated by a taxpayer ordinary in the course of that business? So we've already gone through requirement 1. Was the taxpayer engaged in a trade or business? And if so, what business? We know developer. We've already done that, okay? And that's why we're getting to this. But requirements 2 and 3, you're going to see that the 5th Circuit, they dwelled on certain factors, 7 factors. The first one being the nature and purpose of the acquisition of property and the duration of ownership. The extent and nature of the taxpayer's efforts to sell the property is the second. The third is the number, extent, continuity, and substantiality of the sales. The fourth, that was the third. The fourth is the extent of subdividing, developing, and advertising to increase sales. The fifth is the use of business office for sale of the property. The sixth is the character and degree and supervision or control exercised by the taxpayer over any representative selling the property. And finally, the seventh, the time and effort the taxpayer habitually devoted to the sales. Woo! A mouthful, right? Now, notice the 3 questions came from Suburban Realty, which is the 5th Circuit case in 1980. So it's before 1981. So it's binding on the 11th Circuit. It's binding on Calvin. With respect to the 7 factors, United States versus Winthrop, and that was in 5th Circuit 1969, again, before 1981. So that's binding on Calvin. And by the way, you can check if the factors are still being used by looking for a newer case in the 5th Circuit, which I'm going to show you, or I'm going to talk about one, and they still go through these 7 factors. So that means it's still good law. It's still relevant. You can also check the case, jeopardize it. You can check to see if it's still good law, if it's not been overruled by looking at the case in Checkpoint, Westlaw, CCH, whatever, and you're going to see that it's still good. It's still good law. All right. And by the way, if you're watching this in the future and it does change, this video is out there to help guide you and give you ideas. The process is still the same, right? I'm not teaching you about substantive law here. I'm teaching you about the process, about how we do this, okay? So those are 7 factors that the courts have focused on since United States versus Winthrop. And again, those 2 cases right here, Suburban, which is actually going to be one of the cases that we focus on, one of our 4, and United States versus Winthrop, these 2 cases are in the Fifth Circuit before 1981, and they're still good and relevant law. Even further, when looking at these 7 factors, so these 7 factors I just went through, the Fifth Circuit and even other circuits, there's even other circuits out there. Now, I was able to find specifically the Fourth Circuit in Gray versus Commissioner because that's a case that's very similar to ours. So the Fourth Circuit also follows these similar 7 factors. What they did in determining these 7 factors, again, factors test, very subjective. Different factors can weigh different outcomes. I want to explain how I develop these questions. This is very important, especially if you're starting out in tax research, because developing these questions to do this analysis that we're going to do is very difficult at first. I used various cases. I looked at case law in different tax research databases like Checkpoint or CCH or Westlaw or Lexis. And also, I used AI technology. I put both of those together. The case law is meant to verify and find cases. The AI technology, once you get there, can then lead you onto those questions and save you a lot of time. So first, let's talk about the case law. And in the memo so far, I mentioned 2 cases, the Winthrop case and the Suburban Realty case. And it's really important, if you're watching this video, to actually read both of these cases. Here is the citation, and the case is United States versus Winthrop. That is the name of the case. And it was decided in the Fifth Circuit, October 22nd, 1969. So we're actually going to go through this case together, but I'm not going to read every single word. I'm going to read most of it with you. But it's really important that you read this case and read it a few times to see what I'm getting at with developing these questions. Let's go ahead and start at the opinion. We're given the circuit judge, which could be helpful. Let's go ahead and start by looking at just the beginning of the opinion. We must emerge with a solution to the old, familiar, recurring, vexing, and oftentimes elusive problem described by Judge Brown and Thompson v. Commissioner of the Internal Revenue concerning capital gain versus ordinary income arising out of the sale of subdivided real estate. So a lot of times these judges, they have a very eloquent way of writing things. That's what you can see there. Finding ourselves engulfed in a fog of decisions with gossamer-like distinctions and a quagmire of unworkable, unreliable, and often irrelevant tests, we take the route of ad hoc exploration to find ordinary income. So this is starting off telling you that you're probably going to be dealing with a factors test. Let's go into this in more depth, and we're going to see that. So we're first given some facts. So it's starting off now in first part of the opinion, and we're getting into the facts now. The taxpayer, Guy Winthrop, was the owner of certain property in the environs of Tallahassee, Florida, known as Benton Hills. So for those of you out there, the audience, that might know the Tallahassee area, maybe you're an FSU student or another university in Tallahassee, you might know the Tallahassee area very well. Near Midtown, there's an area called Benton Hills. I actually have a map I'm going to show you, and there's actually a park and a few streets that are named, they're named after this Winthrop. So the property had been in the family since 1836. That's not really anything crucial, just giving you backdrop. Winthrop first received a share of the property in 1932 upon the death of his mother. Additional portions of the property were received by him in 1946, 1948, and 1960 through inheritance and partition. As the city of Tallahassee expanded, its city limits were extended to incorporate most of the Winthrop property, and the taxpayer began to sell lots for home sites. That's very important. We're dealing with looking at our facts, our factual situation and issue of Calvin client. We have to look and see what can be related to ours. The first subdivision was undertaken in 1936, so subdividing property, and the first sales were made in that year. Thereafter, 8 other subdivisions were platted and developed by the taxpayer. Each subdivision was platted separately, and the taxpayer endeavored to sell most of the lots in one subdivision before another was developed. The process was one of gradual, orderly development. All right, let's go ahead and we're going to take a look now at the map. So here is the map. It's part of Tallahassee. You have FSU down here, main part of FSU, and Midtown's over here. And then this area over here is where you have Benton Hills. And as you can see, here's Winthrop Park. So this area in Benton Hills is where you have Winthrop. And look right here, Winthrop Way. So there are some roads in Tallahassee that are named after the Winthrops. And you can see that. Really interesting, especially if you've ever been to the Tallahassee area or you're familiar with it. All right, so let's continue on. We're talking about, again, the Winthrop properties. They were subdivided and whatnot. Each was surveyed and platted. So that's important. Each surveyed and platted. The streets were graded and paved at the Winthrop's expense. So that's very important as well. When you think about our facts, our client or Calvin client has done certain things to the property, so let's keep that in mind. Electricity and water facilities were installed, and in some subdivisions, sewer lines were built, again at Winthrop's expense, although this was eventually repaid out of utility bills incurred by homeowners who moved into subdivisions. Moreover, the taxpayer participated in building 5 houses for sale in addition in order to assist the purchasing and obtaining of FHA loans to finance their homes. So now it goes through and it says, in selling the lots, Winthrop neither advertised nor engaged brokers. Again, looking at facts in our Calvin client dealing with solicitation of offers and whatnot, that's important there. The customers primarily came to his home to conduct the sale negotiations since he did not have an office. He did, however, purchase an annual occupational license as a real estate broker from the city of Tallahassee from 1948 to 1963. So that's important because when you're looking at whether someone is a real estate developer or broker, well, he is a real estate broker. He has that license. All right. So they talk more about the property. They talk about the sale of lots, the profit and other income realized by Winthrop during this time. The taxpayer reported profits from these sales up until 1953, reported them as capital gains, and that's what created the issue where the IRS came in and said, no, we don't think they're capital, we think they're ordinary. And it goes through some more details, but the main part of the facts has really been fleshed out. And by the way, remember, this is the Fifth Circuit case. This is a Fifth Circuit opinion. If you go to the original trial court level opinion, you're actually going to find more facts. So if we were actually to go into that trial court, we actually would find more facts. When the higher up in the appeals level you go, right, to the Circuit Court of Appeals and then U.S. Supreme Court, the facts kind of get more limited because it's no longer the appellate court isn't raising issues of facts, it's raising issues of law on appeal. But there had to be some background here for the appellate court to rule. Okay, so then the second part of the opinion deals with the government and the IRS, deals with the government and taxpayers' arguments. Again, it's pretty clear. The taxpayer wanted capital gain. The government argued, no, it's ordinary income. So we're not going to really read into that as much. Let's continue on in the opinion. All right, let's get down now to part 3. So now the court is starting to talk. While we're in disagreement with the government's first argument concerning taxpayers' efforts, remember, government's arguing that it's ordinary, we find its second argument that the land in question was primarily held for sale in the ordinary course of business. That's our main issue in our memo, and therefore was not a capital asset under 1221 persuasive. So there's the court is saying that they find that the argument by the IRS that it's considered primarily held for sale in the ordinary course of business, and therefore it would be ordinary income asset persuasive. In holding against the government on this point, the court below, so the trial level court appears to have placed particular emphasis on the following facts. The proceeds from the sale of property were not reinvested in real estate. The taxpayer had other investments, none of which were involved in the sale of real estate. The subdivided property was acquired by inheritance, not purchased for the purpose of resale. The taxpayer's holding period was 25 years. The taxpayer maintained no office, made most of the sales from home, spent no time whatever promoting sales, and did not advertise. And the purchasers came to him, and he was selective in making the sales. So that's what the lower court held, and that's why I went ahead and highlighted that, because that's what they made their decision based on. So now let's continue. This is the opinion. The judge that's writing, I should say the court, because the appellate court is more than one judge. There's one justice though one judge actually writes opinion. In relying on these factors, the court below was obviously following earlier suggestions by this court, so talking about the Fifth Circuit, that such facts are relevant in determining the ultimate question of whether or not the land in question was held primarily for sale to customers in the ordinary course of business. So what this opinion is saying is that the lower court, it followed previous cases in terms of the Fifth Circuit. They give a whole slew of various cases. They give the Cole versus Usury case, Barrios Estate versus Commissioner of Internal Revenue, Consolidated Naval Stores versus Foz, Smith versus Dunn. You'll notice they're all Fifth Circuit. In condensed form, the tests mentioned most often are the nature and purpose of the acquisition of property and the duration of ownership, the extent and nature of the taxpayer's efforts to sell the property, the number, extent, continuity, and substantiality of the sales, the extent subdividing, developing, and advertising to increase sales, the use of business office for the sale of property, the character and degree of supervision or control exercised by the taxpayer over any representative selling the property, and the time and effort the taxpayer habitually devoted to the sales. Woo, it's a mouthful. So those 7 factors. That's what the previous courts in the Fifth Circuit have held, because when you think of, or they've looked at those factors. All right. When you think of the idea of precedence, the court here in Winthrop, the Fifth Circuit, they're bound by previous Fifth Circuit cases. And also they're bound by the Supreme Court. All right, so we're continuing on. Despite their frequent use, so now the Winthrop court is saying that despite their frequent use, these 7, this court has often declared that these 7 pillars of capital gain treatment in and of themselves have no independent significance, but only form part of a situation which in the individual case must be considered in its entirety to determine whether or not property involved was held primarily for sale in the ordinary course of business. So what is that saying? It's basically saying that it's a factors test. There's not one specific factor that will win the day. It's a factors. You got to consider the whole package. The words they use is, but only form a part of a situation where the individual case must be considered in its entirety. That is the package. When I talk about the package, it's in its entirety. And again, they cite those cases, those same ones. Okay. Moreover, in Thompson v. Commissioner, this court remarked concerning these tests. So we're looking at, they're citing to this Thompson v. Commissioner case, and this is what the Thompson v. Commissioner case said. Essential as they are in adjudication of cases, we must take guard lest we be so carried away by the proliferation of tests that we forget the statute excludes from capital assets properly held by the taxpayer primarily for sale to customers in the ordinary course of his trade or business. So what they're saying is that we have to follow the statute. Yes, we have these factors, but again, we have to always look back to the statute. Again, we're still in the Thompson case. This all comes from the Thompson case. It's all Thompson. In the instant case, the trial court, so this is within Thompson. In the instant case, the trial court found that these test facts about which there is no disagreement compelled a finding of the ultimate fact that the holding was not primarily for sale in the ordinary course of the taxpayer's business. In weighing the arguments on this point, the court recognizes that the characterization of the taxpayer's manner of holding lands is a question of fact. So again, it's a question of fact, meaning that it's going to be really a factors weight test. The district court's finding on this ultimate issue, however, is not to be garrisoned by the clearly erroneous rule, which that's a standard of review. You talk about clearly erroneous versus other levels of review. Though it has factual underpinnings, this ultimate issue is inherently a question of law. So even though we're dealing with questions of fact with the factors test, it comes down to the question of law, whether it's considered a primarily for sale to customers in the ordinary course of business. So that's what the Thompson reference is for, and the Thompson reference continues on here. Okay, let's go back to the Winthrop opinion, the actual judges of Winthrop. In analyzing a case of this sort, no rubrics of decision or rubbings from the philosopher's stone separate the sellers garlanded with capital gains from those beflowered in the garden of ordinary income. So again, you see this writing style, this eloquent writing style that a lot of justices, when you start getting, especially in the circuit courts and in the Supreme Court, they have. Each case and its facts must be compared with the mandate of the statute. So again, they're saying, okay, well, courts, you've really relied on these factors. But remember, ultimately, Congress writes the statute. And we need to make sure that we're following the conditions of the statute, primarily for sale to customers in the ordinary course of a trade or business. What you're going to see, though, is ultimately we still look at factors. It's kind of like, yes, factors are important, but remember, in the grand scheme, it's the code. In doing so, we note that the enunciations of the Supreme Court are clarion as they enjoin us to construe narrowly the definition of a capital asset and as a corollary interpret its definitional exclusions broadly. We therefore approach the first issue of whether or not Winthrop held the property primarily for sale as that phrase is used in section 1221. So again, they're getting at this phrase and specifically looking at the capital asset issue. This is where the court is finally going to analyze the law with the facts. So it's going to talk about these factors, talk about these requirements, and it's going to talk about the facts of this case and make a decision. Let's go ahead and read. It's undisputed that Winthrop inherited the first portion of the Benton Hills land in 1932. By 1936, the first sales had been made and further subdivisions were underway. Mrs. Winthrop's testimony indicates that, except for subdividing and selling, the land was not used by the taxpayer. So you can see that they focus on the subdividing and selling. According to her, a city employee was allowed to live there, but this was rent-free. Later, another city employee rented a small house for $40 a month, but not the land. Rather, they granted him the right to plant some corn. On the other hand, her testimony was equally clear in showing the taxpayer's activities, so they tend to focus on the activities regarding the land, such as paving the streets and having utilities installed, were done with the express purpose of making it more saleable. So they focus on the intent as well as the what they've done with the property. She testified that he built houses on some of the lots in order to make FHA financing available to prospective purchasers of lots. Moreover, she built some houses, so we can say that there was some properties that were rendered. So you've got the facts at the beginning, and now you've got the court. In this part, it's basically going to the facts, and it's saying which facts are crucial, because not all facts are that important. And this is even more so the case when you have a trial court case, a tax court case, or a tax case at a trial court level, the original court level, like a tax court or U.S. District Court, U.S. Court of Federal Claims. They give all the facts, but they only go really through the ones that are that important. When you start getting to the U.S. Circuit Court of Appeals and Supreme Court, they provide less facts, as I mentioned earlier, so it tends to be that the facts they give you are essential. Moreover, she built some houses on the lots because if a person built a house and there was a house nearby, somebody would wanted the lot because people like neighbors. All right, let's move on to the next page. There were therefore no multiple, dual, or changes of purpose during the relevant year. So it's saying there was no change in the purpose with respect to of Winthrop's Benton Hills sales. The taxpayer, long before the taxpayers in question, had as his sole motivation the sale of Benton Hills lot by lot, year by year, transaction by transaction. So it's saying that his sole motivation, the sale of Benton Hills lot by lot, as we were told in the facts, right? He was telling it each subdivision by subdivision, year by year, transaction by transaction. The evidence is clear and uncontradicted that the lots were at all times held by Winthrop primarily for sale, as the phrase was interpreted by the Supreme Court in Mallet. So again, they're focusing on that intention of the parties. Holding primarily for sale, however, is by itself insufficient to disqualify a taxpayer from capital gains privileges. The sales must also be made in the ordinary course of a taxpayer's trade or business. The next issue, therefore, is, so they're basically they're going through the requirements like we've done in the memo, and they're basically breaking out the conditions. Primarily for sale in ordinary course of trade or business. That being said, the court has not shot down the factors. They specifically said, as we saw earlier, that the factors are fine. What they're saying, though, is that we need to look at the conditions of primarily for sale and to a customer in ordinary course of trade or business as basically two separate conditions like we've done in our memo. Using the factors, though, can be done. And that's what they're doing here. When we're saying factors, which were the 7 factors that we saw before on a previous page, those 7 factors that we went through, they're also getting into the nitty-gritty of the factual questions. And that's what we're developing. We have to figure out, looking at multiple cases that apply to ours, have similar facts, the factual questions. And those factual questions are the ones that I'm creating for our memo that we're going to analyze, because that's how you can do this analytically. You want to get as narrow as possible. So we're going to continue on. So we want to narrow down. You can't just do the 7 factors. And I'm going to show you that even further when we look at the Suburban case, which is a little bit longer. So the next issue is whether the taxpayer's activities constituted a trade or business. So the next issue, therefore, is whether the taxpayer's activities constitute a trade or business. So the court held that it was primarily for sale to customers. That was the intention. So again, from that we take, okay, there's factual intentions of what they plan to do, what types of activities they did the property, those types of things. So now we're looking at whether they were in the trade or business of being like a real estate developer or broker. We think that they did. So they're telling you what they think, and they're going to explain what the court's going to explain its rationale. The magnitude and continuity of his operations and design all point to these sales being part of a business. So we're going to see exactly, that's obviously part of those factors. It makes up a few of the factors, the 7 factors. This was a planned program of subdividing and selling. So subdividing and selling, again, important, lasting over a quarter century. So it actually took place over time, over multiple years. So they're looking at the activities, which we just saw, subdividing and selling. We're looking at the length of time, quarters, how long this has been going on, quarter century. Let's continue on. It constituted Winthrop's principal activity. So this actually was his principal activity. Whether they're looking at that from an income standpoint or number of sales or whatnot, maybe they'll tell us, maybe they won't, maybe we can find other cases, and produced 1/2 of his income. There we go. Produced over 1/2 of his income during the years in question. Sorry if it's hard to read, but I just read it for you. It says producing over 1/2 of his income in the years in question. So that is something else. So what I'm doing here is I'm creating questions from this. So like, for example, this could be a question. This is a question of what kinds of activities did the taxpayer, I should say did, right? Because we're looking at completed facts. Did the taxpayer complete? And maybe provide some examples. Subdividing property, install utilities, survey, we saw that one. And there's many others that we can think of as well, but you get the idea. And the idea here is that because the court is dwelling on this, if the answer is yes and there's multiple, that seems like it's more likely to be ordinary income, because it's more likely that this is treated like you're a developer in property. It's in your trade or business because it's getting at that element. Let me zoom in here so you can see this. So subdividing and selling, quarter of a century, produced over 1/2 his income. We can create another question. Maybe we ask, so let me do another one. Maybe we ask, how long did the taxpayer continue this activity? And we could do this by years, months. Maybe if you're looking at multiple cases, you start seeing that maybe months is better, because this was 25 years, which is a lot. That's a lot. But maybe other ones, it's a function of months. Maybe you're between 3 and 4 years, so maybe it's better to do months. We could also ask, does this activity, does it generate more than half the taxpayer's income? We could ask that. So that's how we're developing these questions. The questions are not, when I teach tax research, students say, where are you getting these questions? I don't see the court saying that. You have to develop this. This is what's called critical thinking. It's very important you're developing these skills. You will be expected to do this. So the idea is that you're making these questions, and you can use these questions in similar cases and say, okay, I looked at 4 different cases and they have these common facts that the courts are focusing on. Let me create a question and then answer it in a chart. So yes or no, okay? Yes or no. You can also, I think using a question format is the best, but you can also just have the fact itself. If you continue reading, let's just go on. I'm not going to show you more questions, but you get the idea. This was no minuscule operation in terms of transaction profit, unlike the taxpayers in Smith v. Smith v. Dunn. The taxpayer here devoted a substantial amount of his time, skill, and financial resources developing and selling the property. So what the court's doing there is it's distinguishing Smith v. Dunn, which probably helped the opposite. Might not, but it might be saying that case also ruled as ordinary income. But look, even this one's even closer to ordinary income. He thereby engaged in the business of subdividing. So they're telling you, he engaged in the business of subdividing real estate for sale. One need not be a static holder to qualify for capital gain treatment, but because the flexing of commercial muscles with frequency and continuity, so frequency continuity matters. So that goes to how many different times you've sold properties, how long. Design and effect does result in disqualification because it indicates one has entered in the business of real estate sales. So it's basically concluding that, again, they think he is. The taxpayer has made much over the fact that no office was used. While advertising, solicitation, and staff are the usual components of business, so they're saying that's important. Was there any advertising, soliciting, and staff used to sell these properties? They are not a necessary element in either the concept of or the pragmatics of selling. So again, it's saying that this is a factor. It's not requirement. It's not a necessary, it's a factor. It can lead to it, but it's not required. Here it is evident that the taxpayer was quite successful in selling the lots without the assistance of these usual props. It is not necessary the customer be actively or fervently and frantically sought. Winthrop had lots to sell and not mousetraps. Again, so they're trying to be very eloquent here and very interesting in how they're writing. So they beat away to his door to buy his lots. As the court remarked in Thompson v. Commissioner, which involved a similar lack of promotional activity. And by the way, if you ever see supra or infra, that just means that for the citation, you can see previously in the opinion, infra it's basically saying if supra and infra refer to, okay, a citation's already been used. So you can see the citation previously or later, which involved a similar lack of promotional activity merely because business was good, indeed brisk, does not make it any less in the ordinary course of such good business. Winthrop was in the business of selling lots in Benton Hills, even though his salesmanship was unorthodox and low pressure. The sales were out of his lots and were made to customers, though these customers sought him out rather than having been pursued. So again, they're saying that yes, the customer sought him out, he didn't solicit, but we don't think that factor alone is important. Enough to, it's important. They don't think it's enough to justify it being capital rather than ordinary. That's what they're trying to say. In addition, we think the sales were ordinary in the course of this business. The concept of normalcy, that's what ordinary deals with when you look at things like section 162, normalcy requires for the application of chronology and the history to determine the sales of lots. All right, so at that I think you get the idea. Again, there's these factual elements that the court is really focusing on. Subdividing and selling. So from that, I created the question. What kinds of activities does the taxpayer complete? And you're going to see that type of question is also in our analysis. Or how long did the taxpayer continue to hold or continue this activity with respect to the lots at question? 25 years. We said quarter of a century. Or did the taxpayer receive more than half of the taxpayer's income from these activities during the years in question? The answer was yes. We're told that. And there's other things. There's no solicitation made by the taxpayer. Things like that. So there's other questions. I'm not going to go through all of them for the sake of time. It would take me, multiple hours. I do want to continue on though, and let's look at another case, the Suburban case, because we talked about that. Okay, so here are some footnotes. And again, if you go and you look at where the footnotes are, you'll see it talks about the number of transactions, the total lots sold, so it's giving you history, and from that we can create questions if you see where the references are, the footnote references are. So again, a lot of these facts, they do make a big difference. Let's continue on now. Again, these are more of the footnotes for the Winthrop decision. All right, so now we're dealing with the other case, the Suburban Realty Company case. Now this opinion is a lot longer So it's Suburban Realty Company versus United States, and here is the court citation. I strongly recommend you read this. I think you get the general idea of how I've created these factual questions, these factual inquiries. The idea is that when you have a factors test, which we've already established, and we saw in the Winthrop case, we saw, hey, there are 7 factors that the Fifth Circuit, it's clear from that the Fifth Circuit follows. They follow that, okay? Fifth Circuit Court of Appeals, they follow, and we went through those 7. The idea is that when you read those 7 factors, you're going to say, some of these include multiple things. So that's the idea, is that you're looking at cases that are similar to your taxpayer. The Winthrop case is similar in some regards to the Calvin client. Suburban is. I found other cases in our memo that we're going to talk about in a moment. I found 3 other cases that are similar, and you see that the judges in all these cases either fall in the 5th Circuit, the 11th Circuit, or the 4th Circuit, which is very similar, as I mentioned. And the idea is that the courts, they're focusing on the same facts. So from that, you can kind of create questions. So it's kind of like critical thinking. You're creating these. I will give you a tool, though, at the end of this, that at the very end of this part of our discussion, that shows you how it can simplify your life a lot. Let's go ahead and continue on. So just like the other opinion, the court starts out, we must today answer the riddle at once adumbrated and apparently foreclosed by the false dichotomy created by the United States Supreme Court and Mallet v. Riddle. When profits have arisen from the ordinary operations of business on the one hand, are also the realization and appreciation over a substantial period of time on the other, are these profits treated as ordinary income or capital? So that's basically how the other court kind of started out. That's how the Winthrop, that's what I meant by other court. If I say other court, I'm talking about Winthrop. Basically, it's saying, okay, this opinion is dealing with whether something is ordinary or capital. That's really what it's saying. And it puts it like, very eloquent words. All right, let's go ahead and continue on to the rest of the opinion. So here, it gives the overall activities and it goes into the sales. Total sales activity from the property between 1939 and 1971, Suburban made at least 244 individual sales of real estate out of the property. And it goes through and it says approximately 95 sales were unplatted and unimproved, and at least 149 of the sales were from platted property restricted to residential development. In each of these 33 years, so it's giving a period of time, it's talking about the sales numbers, which is probably going to be important when you think about the Winthrop, like how much income is received. And then it also talks about, it breaks down the types of property. North Loop, again, it's looking at the duration, it's looking at the number of parcels, it's looking at all these things. 3 corporate discussion investments. So basically the idea is that a corporation was created. We're involving Rice University for anyone out there that's at Rice. All right, let's continue on. So we're looking at these facts. Again, I really recommend that you read this opinion because it's one of the very essential core opinions that goes into our memo. Continuing on with the facts, specific portions talk about Houston Gardens in 1938. Suburban and the other owners of the property formed a separate corporation. And they talk about, they own approximately 200 or 250 lots. And basically, they sold in bulk to builders. These sales covered as many 20, 30, or even 50 lots at a time. So again, this has a lot of similarities to our facts. The Homestead Edition, they go through the facts of that. They go through utility lines put in. They go through designing additions. They talk about all these different things. And you can read in more detail. Again, I don't want to... There's elements in here. Subdivision, there's subdivided lots. A lot of different things that relate to ours. And then other parcels, and they go through the period of time. They talk about the sales, talk about concerning annual sales groups by Suburban, whatnot. You can read to get a better understanding. But the idea is that you're going to see there's a lot of factual stuff that's similar to our fact pattern with Calvin. All right, so now we get to part 2, and now the court actually starts getting into their opinion. I should say the whole thing is the opinion, right? But now they're past the facts. Our analysis in this case must begin with Biedenharn Realty Company, Inc. versus United States, which is a Fifth Circuit case. And this case is in 1976. That's very important because the Winthrop decision, 1969, so the Biedenharn case is the latest. It says it's the Fifth Circuit's latest. So while the Winthrop case is actually more important, you're wondering why isn't Biedenharn being used? Winthrop was the first case that basically said, okay, well, the courts have been just taking these factors tests And now we think that we also need to remind ourselves, the Fifth Circuit, hey, factors are important, but remember, the code is the most important thing. So that's why they broke up that analysis into those two parts, which is the structure of our memo as well, like we did. We broke into primarily for sale to customers and an ordinary trade or business, Okay? So the Biedenharn, the court's latest and only en banc pronouncement concerning the characterization of profits of a real estate business as ordinary income or capital gain. Okay, so it's the most recent one. The decision answers the characterization question by evaluating certain factors, often present in cases of this ilk. So it's talking about the 7 factors. So that's our lucky number 7, our 7 factors. And it goes even further to say substantiality and frequency of sales is called the most important factor and references the Biedenharn, and talks about improvements to land, solicitation, brokerage activities also play a part. So we've already gone through this in Winthrop. A lot of these items, which go to the 7 factors, are what the court focused on the facts, and that's how we created our factual questions, right? Remember we found, and there's a lot more questions that we could have developed from Winthrop, but we created the questions, what kind of activities did the taxpayer do? They did subdividing, they did utilities. Also, we saw the question of how long did the taxpayer do this kind of activity, and we saw 25 years. We created the question, is this taxpayer activity at issue? Does it provide more than half of the income to the taxpayer, total income for the year? And the answer was yes. And all those things, based on the way you answer, can affect whether it's ordinary or capital as a weighing test. So let's continue on. All right, it talks about the Biedenharn framework, and it allows us to ask the question, but gives us little guidance in answering it. Because what you're going to see is that this court, so the Winthrop case is still good law, you're going to see that this court, what they're going to do is they're going to give us some additional questions. And what you're really going to find out is that it's really the same thing. It's just kind of how the court how they organize their analysis. And really, that's why the factual questions are the most important. The factual questions that we need to create, because you'll see that the circuits, they like to say they're doing something different, but really it's the same thing. It's the same analysis, just a different organization. And I'll show you what I mean, right? The Winthrop case, it focused on the 7 factors, and again, it reiterated that there's 2 real conditions in the code under section 1221A1. You're going to see this one's going to say, we think that's fine and the factors are important, but really there's 3 questions, okay? Each of the parties invites us to look back at the case from long ago for guidance and then go into the details and the factors. Today we must go into a territory as yet unmapped in the circuit. Suburban's case is at once more favorable to the taxpayer than Biedenharn's, and less so. More favorable because with respect to the particular parcels of land here at issue, it's undisputed that Suburban undertook no development or subdivision activity. So right there, that is a perfect example of how to write a distinguishing element of a case. You could say that in your memo if you find something that's distinguishing. That's giving you a good example for memo writing. And that, a lot of times, going to a court opinion and seeing how a judge writes something, how they distinguish, can help you in writing a memo as well. That's kind of an extra little tip in there, how to distinguish, the proper language to distinguish. You can find that. All right, let's go now to part 3 of the opinion. The jurisprudence of the real estate capital gains ordinary income issue in this circuit has at times been cast somewhat loose of its statutory meaning. And that's kind of what Winthrop was getting at. They were focusing on, okay, well, we really just focused on these factors, but remember, it ultimately comes down to the code section. The ultimate inquiry in cases of this nature is whether the property at issue was property held by the taxpayer primarily for sale to customers in the ordinary course of his trade or business. In our focus on the tests developed to resolve the question, we have, on occasion, almost lost sight entirely of the statutory framework. So this is in line with Winthrop. This is why I used Winthrop and Suburban together, because it's following the same logic. See that? It's following the same logic. The test or factors, whether they have been counted to number 7, see Winthrop, or to number 4, so they only went to number 4 in Houston Endowment, have seemingly acquired an independent meaning of their own, only loosely tied to their statutory peer. Some years ago, Judge Brown cautioned us this tendency. And Judge Brown in stated that essential as they are in the adjudication of cases, we must guard lest we be so carried away by the proliferation of the tests that we forget the statute excludes from capital assets property held by the taxpayer primarily for sale to customers in the ordinary course of his trade or business. Where did we see that? We saw that in Winthrop. Remember that big chunk that we looked at? That was the main point, is that, hey, yes, factors are important. You got to go back to the code. Code is essential. But you're saying, as someone that's trying to write a memo, you're like, well, the code is so broad. And you're right, it is. But you still need that structure. You still need to set it up that, hey, there's this language in the code, and this is really how you break that down. Then you bring in the factual analysis, and that's why the memo that we've written together that I've shown you, that's why it's structured that way. All right, let's continue on. Okay, the tendency, so this is the court writing, the tendency to overemphasize the independent meaning of the factors has been accompanied by, perhaps even caused by, a tendency to view the statutory language as posing only one question: whether the property was held by the taxpayers primarily for sale to customers in the ordinary course of his trade or business. This determination was correctly seen as the equivalent to the question whether the gain was to be treated as ordinary capital. However, probably because the question is the gain ordinary is a single question which demands an answer of yes or no, the courts, on occasion, lost sight of the fact that the statutory language requires the court to make not one determination, but several separate determinations. Again, you have to focus on these conditions of the code section, and that's what was being lost in terms of sight. And that's why these two cases, Winthrop and Suburban, which are still the law in the 5th and 11th Circuit, and the 4th Circuit follows as well, that's why they're the most important cases when you're looking at the respective circuits. In statutory construction cases, our most important task is to ask the proper questions. In the context of cases like the one before us, the principal inquiries demanded by the statute are, and look at this, it makes three questions. Now these you can think of like factors, but they're really broad questions. These are really broad questions, and what they're doing is they're breaking down the statute itself. Was the taxpayer engaged in a trade or business, and if so, what business? So that goes to the definition of ordinary course of trade or business. Was the taxpayer holding the property primarily for sale in that business? And then was it ordinary? So those three things. So that's important to put in your memo, because if you miss that, then you're not getting that element. So then they go on. They're saying, okay, we're going to start using this type of analysis. We by no means intend to suggest that we disagree with anything decided by the recent 5th Circuit decisions. Biedenharn guides our decision-making process. So what is that saying? It's saying, hey, we're going to use these three questions. These are the three questions. And it's also saying that we're going to do the 7 factors. So the 7 factors from the 5th Circuit are still there. And from that, we can use the same analysis we did in Winthrop. We can go through and make factual questions. Now, I've shown you how to do that, and I will show you in this opinion where you can find the facts that they focus on, but you can create other factual questions from that. It goes on, and it states, having laid the framework for this requisite analysis, we must now apply that framework to the facts here, and then they go on. This is where they go into the respective facts. So you can go through these parts, and you will find, it goes through in question and order. Were they in a real estate business? Were they in a trade or business of real estate? And you can go through and you can look for the facts, just like we did in Winthrop, and create questions. You're basically going through multiple cases. And in the memo, there's actually 5 cases. There's Winthrop, there's Suburban, and there's 3 other cases that I'm going to talk about later on in the memo. And you can look at those 5 cases and you can pull them up. You can search for them online. And if you want to read through those, you can see that, okay, they're very similar to our facts. And you'll see that they all focused on these facts. And that's how I got the questions. For example, they focus here on a 33-year period of the sales taking place. And this averages over 7 transactions per year. The proceeds from the sales exceeded $2.3 million. Going back to our Winthrop case analysis, we also looked at similar issues dealing with duration, the number of sales, those kinds of issues. Let's go on and move to the next question. So here's question B. What was Suburban's primary purpose for holding the properties whose characterization is here in dispute? Now, I'm skipping over the rest of A. You can go through that. Again, I highly recommend you actually read this case, the full opinion. I gave you some samples in the Winthrop. I just showed you some of the facts in A on the previous page. And the idea is that that's how you develop the factual questions that ultimately you use in your compare analysis. Remember, we have the 7 factors from Winthrop, which are important. We also focused on the code section. This case, Suburban, it echoes that and also breaks it down into a 3-part analysis. The factor questions, regardless of the organization, that's where the cases, they have similarities in analysis of facts, and that's why we're developing these questions. So in B, again, what was Suburban's primary purpose for holding the properties whose characterization is here in dispute? There are various facts that are focused on. Let's go to the next page and I'll show you some of those. So this is continuing with question B, and you'll notice that it talks about the continuing sales activity is strong evidence that the latter interpretation is the correct one. So it looks at things like sales activity. It looks at the duration, focuses on dates. The property was acquired in 1937. Sales commenced by 1939. So from that, maybe we can create the question, how long was the property held until the first sale? And the idea there is that the longer it's held, the more investment-like it is. So how long was the property held before first sale? So you'll see here it was from 1937 to 1939. It wasn't that long, right? Maybe less than 2 years, around there, around 2 years. 1937, 1939, around 2 years. Not a long period of time compared to maybe some other cases that have been held. Like when we get later in the memo, I'll show you some other cases. It was held for more than 10 years, and the longer it's held until your first sale, it seems more like an investment. That's the idea. So we're focusing on, again, facts that we find common among these cases to do this factual analysis to show how the factors work, where the courts have focused, and again weighing and saying, okay, well, this question, how long was the property held before the first sale? If we answer that and it's very long, it's more likely to be capital asset as an investment holding property. But if it's less, on the lesser side, then it's more likely to be ordinary income because it's more likely you're churning over subdivided lots. That's the idea, like inventory. All right, let's continue on. All right, now we have question C. Were the sales contemplated by Suburban ordinary in the course of Suburban's business? So this one's actually really short. It's just right here. And actually what the court does is says, we need say no more on this question than quote from the discussion of the issue in Winthrop. So in the Winthrop case we saw, and this is very important language, the concept of normalcy requires for its application a chronology and a history to determine if the sales of the lots to customers were the usual or departure from the norm. History and chronology here combine to demonstrate that the taxpayer did not sell the lots as an abnormal or unexpected event. Taxpayer began selling shortly after he acquired the land. He never used the land for any other purpose and continued this course of conduct over a number of years. Thus, the sales were ordinary. The same is true here. So the idea there is, from the factual analysis already, it's kind of like it speaks for itself, and they just basically cited to Winthrop. Now, one thing in A and B, I didn't really get into the footnotes. There was a bunch of footnotes that were presented. I'm going to show you those on the next few pages, and where there's factual elements, the number of sales and whatnot, and those are also important. We can create questions from that as well. So part V of the opinion is where the holding is found, or the ending, I should say. So basically it concludes that it's ordinary treatment. It's ultimately ordinary treatment, and let's go on now. And then part 6 is where the decision of the district court dismissing Suburban's complaint is affirmed. So again, they're agreeing with the government. It's considered ordinary. Now, the appendix provides information on the number of sales and the dates. Very important, because remember, we saw that frequency and duration is very important. That's where we created a lot of our questions. This continues with the appendix. Very important to understand, because notice in the Winthrop decision, we also had a similar breakdown. In Winthrop, we were given a breakdown of the number of sales, the amounts, all these different things. So a very similar breakdown, and the idea you can take away from that is that the number of sales, the duration, when they're actually occurring, over what period of time, all that stuff is created questions. You'll see that those questions are on the list of questions that I've created on the memo. Let's go on. So if it continues on, and it's the end of the appendix. We're about to get to the footnotes. So again, same idea we just talked about, and the citations. Let's go to the footnotes. So here are the footnotes, and there are a lot of pieces of facts that are given. Like, for example, footnote 5 here, very important. It talks about the acreage, the sales price, those things. And there's other factual elements in these footnotes. And if you go back to questions A and B, or just the area of the facts, you'll see that a lot of those are referenced. So again, more footnotes, just lots of facts here. Also some case citing and talking about different cases. A lot more facts. Again, continuing on. And I highly recommend, again, reading the entire opinion to get an idea of what I'm doing. You do have my list of questions, so it helps you understand. Continuing on. And the final part of the footnotes. All right, so we've gone through the two cases. We went through Winthrop, we went through Suburban Realty, two really important cases. We talked about those already in the memo, and from those cases and three other cases that I have found, which I'll reference later in the memo, I was able to identify similar factual analysis, and that's where the questions were created. Now, if you are a new tax professional, or maybe you're in my tax research class, there is kind of a shortcut to finding these factual questions for certain tax issues. Now, if you're in my tax research class, the memos that I'm going to give you deal with these factors issues, if it's a factor-related memo. So you can use this artificial intelligence technology. And there's different artificial intelligence technology out there that does similar things. I have a video on using AI in tax research, and I talk about tax foresight. And that's just one different software that can be used. What this does, Blue Jay Tax foresight, it does a bunch of different things, but the thing I use it in practice and what I teach, anything that's a factors test, like defining a trade or business, worker classification, like independent contractor versus employee, or debt versus equity. They go through a fact question analysis, which is awesome because if you are a new tax professional, it actually helps you put together these questions that you can use in a memo. It also goes through and it gives you a gut check in terms of your conclusion. So one of the outcome predictors, they call them, is real estate. Is the piece of real estate a capital asset under section 1221 IR of the IRC? So it's basically the question in our memo for our client. And it's also the question that was the main issue in Winthrop and Suburban Realty, whether the land in those transactions that was subdivided and whatnot, whether it's considered a capital asset or it's considered an ordinary income asset. And that's what this deals with. And it breaks down just that, and it talks about those issues. You're welcome to read that. And this tax foresight software, if you're interested, go to the website. You can get a free trial, free test drive, and just look at that. But it kind of shows you. And if you don't have access to something like this, then again, you can always just go through cases, find cases that are similar to yours, and again, find factual comparisons and create your own questions. But this is a shortcut method. All right, let's go on. What I'm going to do is I'm going to show you the first page, the acquisition page, what the first questions are, and then from there, I'm going to give you all the questions, 1 through 4. Okay, of all the 4 groups. And that's going to show you the questions and how I got the questions for our fact pattern. And again, I've tied them back to the case. So let's go ahead and take a look at that. So this is what it looks like when you go into the software. You actually see the questions. We are in the acquisition portion. There's acquisition, development and sales efforts, disposition, and frequency and substantiality. With the frequency and substantiality, as we learned in Winthrop and Suburban Realty, being by far the most important. Let me do a red highlight because that one is very important. That's a very important set of factors, the most important, right? Frequency, substantiality. A lot of the questions that we created in this specific part of the video as samples dealt with frequency and substantiality. So these questions are, in which federal circuit does jurisdiction over this matter lie? Sorry, let me do a highlighter there. I get a little, go a little overboard with the pen sometimes. In which federal judicial circuit does this jurisdiction over the matter lie? So for our fact pattern, it'd be the 11th Circuit, which remember, before 1981, before that time, before a certain date in 1981, there was no 11th Circuit, so we look back to the 5th Circuit. Okay, and that's why Winthrop, which was 5th Circuit before that date, and Suburban Realty, again, before that date, are good law because they're still good in the 5th Circuit, and therefore they apply in the 11th Circuit. Was the property acquired in a single transaction? At the time of acquisition, notwithstanding subsequent changes in intention, did the taxpayer primarily intend for property to be held as investment? So you can see these are questions. Some of them are yes or no. Other questions are you answer it. So for 1.1, for our case, we put 11th Circuit. For 1.2, was the property acquired in a single transaction? Yes, it was acquired in a single transaction for our client. 1.3, at time of acquisition, notwithstanding subsequent change in intention, did the taxpayer primarily intend for the property to be held as an investment? No, they did not. So that's the idea. That's the idea. Now, what you see I've answered on this, I didn't answer that for our fact pattern. When you see the questions, ignore those. I went through the software to show you all the questions. Okay, let's take a look at all the questions now. So again, ignore these answers. I'm just showing you how these questions are developed. So again, if you're taking my tax research class, or you're taking another tax research class, and you're expected to do a factors memo, I highly recommend going into Tax Foresight, getting the questions from there for your factual analysis. I'm telling you to do it if you're in my class, because it's going to save you a lot of time. And those are questions that attorneys that are very prominent in the area of tax, they've already figured out for you. They've done a lot of the legwork for you. Why recreate the wheel when it's already been done for you? So you'd have this question, you'd have this one, and you'd have this one on your list. Let's go on to the next set of questions, number 2. We've got 3 questions already. Now we've got 4, 5, 6, and 7. So this is question 4. This is question 5, this is question 6, and this is question 7. I'm going to go through all the questions with you in a moment, but I just want to tell you that's how I'm getting this. Then we've got some more on disposition. So this is 8, 9, 10, 11, 12, and 13. So 8, 9, 10, 11, 12, and 13. Boom, just like that, right? This is good. This is helping us. And what we're going to do is we're going to compare cases that we think are similar, and we want to find a number of cases that rule capital asset, and a number of cases that rule ordinary, and compare and contrast. That's what we're going to do. And by making those arguments, it helps our reader understand, okay, well, our case is more similar to this rather than this, so it makes more sense that the outcome of the court would be to rule this way because they're bound by the precedent of the 5th Circuit or the 4th Circuit because it's very similar. They're not bound by the 4th Circuit, but it's similar, right? It's a similar rationale. That's the idea. Here's our last group of questions, frequency of substantiality. Again, most important. We got question 14, 15, 16, 17, 18, and 19. So 14, 15, 16, 17, 18, 19. Boom. We got 19 questions. And I'm going to go through all of those 19 questions with you. We're going to analyze those questions, but that's how I've developed those questions. Now, if you go look in Winthrop and you look in Suburban might even be a little bit better, you will see that these questions were either stressed in the facts and or they were stressed in the analysis of the opinion. So those 2 cases and many other cases out there in this area of tax and determining whether something is a capital asset determining whether it's section 1221A1 issue, determining whether land is being sold for capital asset, ordinary income to someone like a dealer or developer, they have these similarities. So this software is awesome because it's done that for you. It's giving you those questions. Before we had this software, what did we have to do as tax professionals? We had to go out and actually do these questions. Now, there would be times if you work at an accounting firm or a law firm that, you go into your tax research database and someone's already done an analysis. You can use that, right? Again, don't recreate the wheel. But this has already been done for you, and they spent thousands of hours on this specific issue and other issues, thousands of hours on each issue, getting those factors for you. And they used AI. They used artificial intelligence to get that. And again, if you want to know more about that, I have a video on the AI. All right, so now I've shown you how to get these 19 questions. Again, we looked at cases and we looked at AI. I went with the AI because, again, computers are ultimately going to be able to process much more words, right? We actually read the opinion. AI, they can read, computers, they can read millions of words and from these opinions in a matter of seconds. And they can see trends. They can see, okay, well, there's a number of duration. That's something they pick up on that fast. And that's the idea, right? Don't try to outsmart the computers on this, when you're trying to cram all this data. It's not going to happen. You're not going to be able to do it. Right? Maybe challenge the computers when it comes to judgment calls, right? Which factors might be weighted more. But when it comes to just processing a data, AI, right? AI's got you beat. So that's why it's our friend. If you don't have it, you can still do it the old-fashioned way by looking at the cases, and I showed you how you would develop questions from that you can use consistently. But if you've got the ability to use AI, do it. And again, if you're in my class, do it as well. All right, let's go on. Let's continue now to the questions. These questions, there are 19 questions specifically, all right? 19 questions. And I go through and I list all these questions. I list them by letter. And the reason why is because you're going to see that I create a table later on so we can help guide through. The first question is, which U.S. Circuit of Appeals applies to the case? That's pretty self-evident. If you have a case in the 9th Circuit or 2nd Circuit, they might not follow the same factors as the 5th or the 11th or the 4th, where I found that there's similarity. So that's important. So you have to find cases that are also in your circuit, unless you can't find them. Now, fortunately for this issue, because there's hundreds, even thousands of cases on this issue, you can find cases that are similar to our facts for Calvin in the 5th Circuit and the 4th Circuit and whatnot. Second question, was the property acquired in a single transaction? The idea there is that if it was acquired in a single transaction, it's more likely to be considered capital rather than ordinary. Multiple transaction, more likely to be ordinary, because the idea is that you're acquiring it over time, maybe various parcels, kind of like inventory, where you're acquiring inventory and selling them over time. That's the idea. And if it helps you understand, land sales as a developer is not exactly the same as like if you're a retailer of inventory, because obviously land sales, you're not going to have as much items, right? And each item is more specific than, say, if you're selling widgets or toys where everything is the same exact item, right? It makes a difference. Land is going to be unique. Each plot of land is different. It's got different geographical markers. It's got different things that there's differences to it. Okay, there's differences to it. So it's a little bit more different than that. But if it helps you understand, think of it like a retailer with inventory in these cases, if it helps you get a better idea. C, at the time of acquisition, regardless of subsequent changes in the intention, did the taxpayer primarily intend for the property to be held as investment? Of course, if they primarily held to be held as investment, it makes it more like capital. If not, more like ordinary. Now we're going to go through we're going to answer these questions later on for Calvin, and we're also going to look at 4 cases that are similar to Calvin, and I'm going to explain how I picked those 4 cases, and it's going to help make a lot more sense. And I definitely recommend following this structure whenever you're doing a factors test, because again, factors test can be very, very challenging, so it's very, very important. Okay, D, did the taxpayer or those with shared interest conduct any of the following development or improvement activities with respect to the property? Surveying, pursuing or rezoning applications, subdividing, removing liens, installing utilities, building a new structure, or similar items. The idea is that the more of these, items, the more likely it's ordinary, because again, you're doing things that are seen more like a developer, where you're turning around these properties and selling them as parcels to people who are going to build on. E, did the taxpayer's development and improvement activities represent consistent and substantial efforts throughout the period of the holding property? If so, it's more like income. If not, it's more like you're just holding it for investment, like maybe you're thinking that the property value is just going to go up. That makes it more like investment. F, did the taxpayer's sales activities represent consistent and substantial efforts throughout the period of the holding the property at issue? Again, similar idea. If it's more consistent throughout, it seems more like income, but if not, it's more like you're just purchasing property, thinking that it's going to just go up in value in a period of time. Maybe there's economic boom coming. You're predicting speculation, just like with stock. G, did the taxpayer receive one or more unsolicited offers for the property from potential purchasers? If there's more unsolicited offers, then it becomes more like investment property, because the idea is that if the property value is going up, then it becomes more of a seller's market than a buyer's market. So more unsolicited offers, it becomes more capital or investment. Less, or if you didn't get any, it becomes more like, well, then you're advertising and you're the one soliciting because you're doing sales. That's the idea. H, what was the time in months from the acquisition of the property at issue to the first disposition? The idea is that if you hold it longer, the longer you're likely to hold it, the more likely it is to be capital, because again, over time is where land generally goes up in value. Now, you might have economic booms, but generally speaking, the longer you hold, the more likely it is to be considered investment. The less likely, it's more like you're turning around inventory. Again, think of like a retailer. With inventory, they want to get that inventory out the door as quickly as possible. They don't want it to sit in their warehouse. Think of it like that. And again, we're going to answer these questions later on. Let's continue on. I, J, K, L, and M all deal with the reasons why the taxpayer changed. Again, our fact pattern and all these different cases you're going to see, which are very similar, they deal with a taxpayer that started off as a developer, but then ultimately they changed their mind about selling the property for different reasons. Now, depending on the question, I'm not going to read through all of these because we're going to go through some of them that make a difference. Some of them don't make a difference, so it's not really that important for our specific factual analysis. Depending on what changed the motivation from going from development to speculating on the value, that could make a difference. For example, question J, was the taxpayer's decision to dispose of the property motivated by an unexpected change in the value of property? Well, if it is, then it's more likely that it shows that it's ordinary income treated, or should be more treated like ordinary income, because they didn't really want to change their intention of being a developer. It's just that the economics worked out that, hey, it makes more sense for them to sell it as an investment. So it goes to the intentions of the items. Question N, how many real property dispositions are at issue? So the more that there are, the more likely that it's to be considered ordinary, because again, you're more like a developer where you're selling lots of parcels at different times, versus if you're selling at one transaction, it seems more like, okay, like an investment sale. O, over what period of time and months the dispositions at issue take place? So you're measuring from the first disposition to the last one. And the idea is that if there's a longer period of time, generally it's viewed as, okay, that again, it's taking place over a longer period of time, and land sales to turn over take a while. So it kind of shows you that it kind of shows the court that there's a longer period in terms of how long you're seeking people to purchase. So the longer it is, that lends itself more to ordinary income. P, how many real property dispositions did the taxpayer undertake in the 5 years prior to the first disposition at issue? With that one, again, if there's more, it's more likely to be ordinary, because again, it shows that the developer, they're doing a lot of things that would show, okay, maybe they changed their mind about being developer for this property, but elsewhere they're developer. So again, it's kind of bringing the Midas touch into play. Q, over the tax years in question, can the majority of the taxpayer's total income be attributed to the transactions at issue? So you look at their majority income, the total income they receive, and if a majority of the income can be from that transaction, and again, they're a developer, then it looks more likely that that's majority of their income. And if it is, it's more likely that it's ordinary, because that's what their general trader business is. That's what they mainly do. Versus if it's just a small, 10% of their income on the side, then that's a different story, because maybe they're just trying to do some investment transactions on the side. R, at any time during the duration of ownership was the taxpayer or those with shared interests working as a builder, tradesperson, property developer, real estate agent, real estate related business or occupation? If yes, then again, more likely to be ordinary. S, were the majority of the proceeds from the transaction is used to purchase real property? If yes, then more likely to be ordinary. So what I did, those are our 19 questions. Then you research, again, focusing on circuits where cases are similar, like the 5th Circuit, 11th Circuit. Also, if you want to go outside of that, the 4th Circuit, because the 4th Circuit uses similar factors to the 5th. They use a similar Winthrop analysis. And you want to find cases that are as similar as possible to Calvin's. Now, you're not going to. If it was that easy, the client they wouldn't pay you hundreds of dollars an hour as a CPA or an attorney or enrolled agent to be researching this stuff. They probably looked themselves and they probably came across, oh, this is a very difficult issue. It's a factors test, and they want you to be looking at this stuff. So these 4 following cases, and I've labeled these 1, 2, 3, and 4, which those numbers are going to be very important, because you're going to see that later on I have a table, and that table is broken into cases 1 and 2 on the left and 3 and 4 on the right. In the middle, we're going to have Calvin's facts. Put Cal. And the cases 1 and 2, the courts held that it was ordinary. So ultimately ordinary, going through all the factors, all the factual analyses, all 19. And cases 3 and 4 held that it was capital. And the idea is you want to find, at a minimum, one case that is in the same jurisdiction. Okay, so we have 5th here, we've got 11th here, and you're going to see that this tax court memorandum was also decided in Texas, so they used the 5th, so that would also be applicable. This is the 4th, and that's persuasive, but if it came to court, you can make the argument, hey, look, Judge, the 4th follows the 5th, so they're all technically, except for the 4th. I mean, you can make the argument that, again, I made it earlier, you could argue that, they're all binding. Definitely cases 1, 3, and 4 are binding. On Calvin being in Florida, you can make the argument as well that case 2. But you want to find at a minimum one case on both sides. Ordinary, one case on ordinary, one case on capital, that's binding. That's in the same jurisdiction as the taxpayer. You want to go through and you want to do that. And if you can't, then what you need to do is you need to still use law from your circuit, but you need to find, again, circuits like the 4th where they use similar factors and whatnot. And that's possible for a lot of factors tests out there. There's a lot of factors tests where you can do that. You can find circuits that are similar, that use similar analysis. Okay, use similar analysis. So the idea is what we're going to do is I'm going to have a table that these 4 cases that you see the answers to all 19 questions, and then we have Calvin's, and then where we find similarities, it makes no sense for us to compare because we can't really distinguish what makes something ordinary versus capital because it's all the same for all 4 cases. So that's not really going to be helpful. But when we have differences, then we can kind of say, okay, well, Calvin's case seems more like an ordinary or more like the capital in that case and answer the question and makes it more ordinary or capital. And then we look at those questions ultimately and we focus on those questions. It's not, again, just a majority, but if you have, 10 questions that have differences and 9 of the 10 are in favor of ordinary, then it's going to be ordinary, okay? Or that's how the court almost surely would go down. But if it's 6 and 4, that's not necessarily going to win the day. Or if it's 5 and 5, I mean, obviously that makes a big issue too. There's some factors that are more important than others. We're going to talk about those as well. Now, one thing I want to note, I've got a video, and I didn't want to talk about this too much in the video because, again, it's a separate video. I talk about artificial intelligence in tax, and I talk about a tax software that uses artificial intelligence. And what it does is I found these cases in the artificial intelligence software. So I found them in the tax research databases, Checkpoint, Westlaw, Lexis, CCH. But I also found them in the artificial intelligence software. And it basically gave me the prediction of what it would predict with a confidence interval of those issues. Okay, of those issues. And also you're going to see on the chart I have those numbers. So the courts concluded in cases 1 and 2, as I said already, that the taxpayers in cases 1 and 2, ordinary income. Dispositions are ordinary. Again, all 4 cases have very much a lot of similarities, but also some differences with Calvin's. Cases 3 and 4, they concluded capital gain. Now, when you're looking at the artificial intelligence software, because the choices there's only 2 choices, right? There's only 2 outcomes. The outcomes are, it's a continuum. The outcomes are ordinary over here, 100% certainty, and over here is capital. The idea is that in the middle is 50%. So we increase 50%, we go up from 50%, and then we go up from 50%. So it never goes below 50%, okay? It never goes below 50% is the idea. 50% would mean it's a toss-up if it's 50%. But if it's 51%, it would be 51% or more for each of these. So you're not ever going to go below. The idea is that in tax, the more likely than not idea, more likely than not concept, is that you must have greater than 50% certainty about a position. And that's very important for frivolous claims before the IRS and penalties if you're prepared, having authority to substantiate that. And that's why they have that scale. And they say confidence interval or how confident they are, confidence level, and that's really what they're getting at, the more likely than not concept. And that's why I use the more likely than not concept, that language in the actual conclusion, which you should always use in your conclusion as well. So keep that in mind, is that the percentages, they start at 50%. So case 1 was a 59% confidence level. Case 2 was 51%. Whoa, that's real close. We were like almost right in the middle. So case 2, even though, again, the court ultimately held ordinary, it's really close to being capital. Case 1, not as close, but still quite close. Case 3 and case 4 were capital, were held capital gain. Case 3 is a 65% confidence level, and case 4 is 68%. So these have even more certainty that they're going to be capital than the opposite end, where those are considered ordinary. So just keep that in mind, all right? So now we're going to take a look at the table. There's a table I've created, and when I've taught factors tests in the past to students, when you're first learning this is tough. It really is tough because a lot of times you're used to learning bright line rules and applying rules. Oh, you have to have this. You have to have a separation agreement. You have to meet this condition. You have to meet that condition. You have to meet certain requirements. Well, that's not the case for factors tests. You might not meet a specific factor, but you still potentially can again get whatever position you want. It's a weighing. It's all about weight, the weight of authority. So I went through fact by fact the 4 cases, again similarities, also Calvin's case, and I created a table. And this table is going to help you understand factors. Let's go ahead and look at that. All right, so here is the table. Again, we have cases 1, 2, 3, and 4. As I've told you, here are these percentages. So if you need to know the case again, it's on the previous page. We've got the Suburban, we've got Connor, we've got Graves. Sorry, Suburban is case 1, Graves is case 2, the Sugarland LLC is case 3, and Connor is case 4. So case 1 and case 2 resulted in ordinary treatment. Case 3 and case 4, they resulted in capital treatment, ultimately. Okay, ultimately, held by the court. Calvin's facts are here in the middle. So I've gone through and I've answered the questions, what we've gone through A through S. A through S. And if you need to go back and you need to look at the facts, and you also need to go through my questions A through S and how I explain which way it would lean if you answered a question, you can do that. Okay, you can do that. You can stop the video. You can do that. Very helpful if you do that. All right. So notice, if it's a red shaded cell, if there's a red shaded cell, the baseline here is Calvin's. Calvin's information is our baseline. Anything that's different is a red cell. So for example, row A is the circuit. Calvin is in the 11th circuit. Case 4 was in the 11th circuit, was affirmed, so that's the same. Anything in the 5th circuit is the same because we found out that, okay, prior to October of 1981, 5th circuit applies to 11th. And then the 4th circuit we learned is also they apply similar factors. So all the same. And then, for example, question C. Everything is no. No, 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 no. Okay? But look at B. Everything is yes except for case 3. There's no here, so that's where we're using this. This is where if there's a difference, if that case had a difference from Calvin's, then that's the red cell is shaded red for that reason. Okay? You can kind of see anything. So we have subdivided utilities. This is the only one with the same. The other two, they don't have the same. They don't have both. So it's red. That's what we're doing. So anytime that we've got a question like A, C, E, F, G, K, L, M, R, and S. Anytime that we have a question where for all 4 cases it's identical, we're going to ignore that question. You're saying, well, what do you mean ignore that question? The reason why we're ignoring it, yes, the factors are still important. You have to consider all 19 factors when you're going before a court. I'm not saying that, hey, we're going to ignore this for good. It's just that when we're using our analysis, we're using our reasoning to get to a result. It won't do us any good because if all 4 cases have, I should say all 5, right, including Calvin's, if all 5 cases have the same fact, how can you differentiate one versus the other? You can't say, okay, well, case 1 and 2 have the same as Calvin's, and therefore and that's ordinary, so it seems more like Calvin should be ordinary there because case 3 and 4 are different. You can't do that because everything's the same, so there's no way to kind of compare and contrast. So that's why we're not going to focus on those, okay? And by the way, the non-shaded cells, those ones are the same. So anytime we have the same question or same answer, it's the same. So again, I went ahead and I X'd out questions A, C, E, F, G, K, L, M, R, and S, and that's 10 questions. 10 questions have the same answer, which I go down here and I mentioned that as well. 10 of them have the same answer. It's not going to help us. So the focus should be on the 9 questions that have differences. So we're going to be going through questions B, D, I, J, N, O, P, and Q, those 9 questions, and we're going to see, okay, how did Calvin answer, which we can see here in the middle, so if you need to go back and you need to see this, how did Calvin answer? All right, how did Calvin answer? So you can go back to this, and I have it in the respective question. So I have it actually in there. But if you need to go back and pause the video and go back, you can see here's Calvin's facts. So how did Calvin answer? And then what does that mean? Whether, if there's a pattern that emerges, does that mean it's more likely for that factor to be weighed in favor of ordinary and be weighed in favor of capital? That's kind of how we're doing this. And we're also distinguishing and we're trying to make comparisons to the cases themselves for things that are like numbers, like 24 months and 36 months and 2, which one are we more similar to? Another thing is you can kind of hold the 10 questions that I mentioned that we're not going to consider. You can kind of hold those questions for the 4 cases in Calvin's case kind of constant just because it's constant information. So that's why we're also focusing on the other questions, and then those are going to tip the scale. So basically what I'm saying is that go through the 10 questions and, hey, let's just say the scales are, for this analysis, are neutral. Now that's not necessarily the case because in practice, if you did have another set of facts, you might have a different answer, and then you'd have to go to that question, and that could tip the scale. So I'm not saying that like, these questions you're equal regardless what the answer is. I'm just saying that because again, all 4 cases in Calvin's case are the same. It's kind of like the scales are kind of the scales of justice are equal at that point. So now we're going through the 9 questions. So let's go ahead and start with question B. Was the property acquired in a single transaction? So looking at the cases, case 1, 2, and 4, the taxpayer acquired the property at issue in a single transaction. In case 3, the taxpayer acquired the property over multiple transactions. If the acquisition occurs over multiple transactions, then the courts have held that for this factor, the outcome is more likely to be ordinary income. So if it's multiple transactions, more likely to be ordinary. However, look at case 3. Case 3 was ultimately considered capital. So that to me suggests that it's not a strong factor. Calvin's is, so let's go to the next page. Calvin acquired the property at issue in one transaction, which does weigh the scales more in favor of capital, right? Multiple transactions would be ordinary. However, again, case 3 was multiple, but it ultimately was capital. So again, I would say this is not a strong factor. It's not what we call a super factor. It's just a factor, a general factor. Okay, next question, D. Did the taxpayer or those with shared interests conduct any of the following development or improvement activities with respect to the property? Surveying, pursuing zoning or rezoning applications, subdividing, removing liens, installing utilities, building a new structure, or similar items. So cases 2, 3, and 4 had only one of these development improvement activities. So if you go and you look back at the facts, you're going to see that case 2, case 3, case 4, they've only got one of those, that list. Other, utilities, subdividing, only one of those. Now, case 1 had the exact same 2 development activities as Calvin's facts. So it had subdivide and it had utilities both. So it has 2. The other ones only have 1. Now, a pattern emerges that if there's more than 1, it increases the likelihood. So cases 3 and 4, they ultimately were held as capital. The idea here is that the more you have, the more likely it is to be ordinary income. So this weighs in favor, having 2, looking at the percentages, right? Remember case 2 was 51% ordinary income under our predictor for AI. And by the way, I keep referencing that AI. depending on who your tax research instructor or your supervisor is, they might not like you talking about the AI. I do, so if you want to mention that, you can. But if you're in my class, I might ask you to do so, but you also don't have to do so as well. I think it was good though to show you the percentages in there, because as AI becomes more and more in tax research, it's going to be even more helpful in respect to these factors tests. So the idea is that Calvin's case is more similar to case 1, where again, case 1 was the one that was the closest to ordinary in terms of percentages. So we're getting closer over to that side on ordinary. We're pushing more. Again, the scales are pushing that way towards ordinary. Okay, so far we've only answered 2 questions. The first question, B, specifically weighed in favor of capital treatment, and then D weighs ordinary. But B, again, looking at the ultimate outcomes, when you're trying to do this, it looked like it was not a strong factor. We have to continue to do the factors. Again, you can't just make the decision on 2 factors alone. Okay, H. What was the time in months from the acquisition of the property at issue to the first disposition? So in cases 3 and 4, where again, the court ruled that the ultimate outcome was capital, the taxpayers held the property at issue before the disposition for near 8 years and 13 years. Wow, that's a long time. 8 and 13 years. Cases 1 and 2, though, were 1.5 and 4 years. So Calvin held the property for 2 years, which lends itself more to cases 1 and 2, especially case 1, right? 18 months or 1.5 years and 2 years. I mean, again, just like the item above, it's getting closer and closer to ordinary. We're going closer to case 1, not case 2. Now, case 1 is 1.5 years, and the rule is, the pattern, the courts have held that for this factor, the longer the property is held, the less likely it's ordinary income. Because again, I explained earlier that if you're holding property for a long period of time, it's like you're thinking about the appreciation and value, because generally land increases over time. But if you're holding it for a long time, that's even more so the case, right? Because you might have like dips in value and it goes back up, like a roller coaster, right? So that's the idea, is that if you're holding for a long time and you are speculating the value to go up. So it's more like case 1, but it's not 1.5 years, it's 2 years, but that's the closest one. 1.5 and 2, it's the closest, it's within 6 months. 4 years, I mean, you're 2 years off. So case 1 is the closest, and this would tip the scales, this factor, to be more likely to be ordinary income. So we've done 3 questions so far. 1 capital, 2 ordinary. Let's go on. I. Was there any change in circumstances that affected the taxpayer's ability to fulfill the primary intention with respect to the property at issue? So cases 3 and 4, the taxpayers were not able to fulfill their primary intentions. They weren't able to fulfill it. And cases 1 and 2, they could still fulfill their primary intention. They just switched for some reason. This factor, being that cases 3 and 4 ultimately led to capital treatment, you could see a pattern that cases 1 and 2, it's more likely in those cases that it could be considered ordinary income, because cases 1 and 2, which, by the way, Calvin's facts are more akin to cases 1 and 2, because Calvin could still sell that property as a developer, those parcels. He just saw an economic boom, so he decided, hey, I'm going to go switch to speculating on the value, because I think I could get more money in the future when the land goes up. Land value goes up because of the economic boom. All right, question J. Was the taxpayer's decision to dispose of property motivated by unexpected change in the value of property? So cases 1 and 4, there was no motivation of change. Cases 2 and 3, there was motivation by change in value. So this is like a split, because cases 1 and 4, there was no change. Case 1 was ruled out ordinary. Case 4 was ruled capital. Case 2, there was motivation and change in value. Case 2 was ordinary. Case 3 was not, was capital. So it's a split. Now, Calvin indicated he was motivated by increase in value due to sudden economic boom. And the courts have held that, hey, if you do have an increase in value due to a boom or something economics, that seems more likely to be ordinary income. So this would lend itself more like ordinary income. However, it's a more limited factor. And the reason why is because, again, there's no prediction. Not like the previous question where, hey, cases 1 and 2, where the court ruled that it would be ordinary. They both had the same answer to the question. Case 3 and 4, which was capital, they had the same answer. That's a pattern, right? That's a pattern. There's no pattern for this one. So again, this factor weighs that it's more likely to be ordinary, but again, the pattern isn't there for looking at the cases, for compare and contrast. Okay, now we go to question N. So far, I mean, we've only got what? 2 capital, 1 capital, but we've already gone through quite a few questions, and most of them are ordinary. Let's continue on. N, how many real property dispositions are at issue? So cases 2, 3, and 4 had 1 or 2 dispositions. Case 1 had 5. So a pattern emerges where if the taxpayer has more dispositions, then it increases the likelihood it's considered ordinary income. Because the idea is that if you're making a lot more dispositions at issue, that you're more likely to be considered a developer selling these as lots to different people. Calvin only had 2, and there's actually a case. One of the cases 3 and 4 actually had 2 as well. So this actually lends itself more likely to be capital treatment because there's only 1 or 2 transactions at issue. So far, we've gone through quite a few questions, and only 2 of them have resulted in capital treatment. The 4 other questions we considered so far resulted in ordinary. So far, it's looking more like ordinary. Again, though, we have to consider the last 3 questions because it could balance out. We could have 5. The last 3 could be in favor of ordinary, and then we have to weigh, what factors are more important than others, right? We saw some of them, there's no pattern, others are a pattern. Some of them we're going to talk about are going to be considered more important by the courts. So let's just go ahead and take a look at the last 3 questions. So over what period of time and months did the dispositions at issue take place? So case 2, 3, and 4 had 1 disposition, which results only in 1 month. Or the 2 dispositions took place during the 1 month. So in some of those cases, I think 2 of the cases, there was only 1 transaction, so you put 1 month because it only happened during 1 month. In one of the cases, there was 2 transactions, and they occurred with both dispositions occurred within 1 month. Now, case 1, the dispositions at issue, there was 5 of them. They occurred over 28 months. There's a pattern emerges where the longer it is, the greater period of time of dispositions at issue, the more likely it's to be ordinary because the idea is that, again, you're turning around this property as parcels rather than just selling it off as one transaction as an investment type land that you're speculating the value. You're just selling it all at one time. So that's the idea. Well, Calvin's first disposition occurred January of year 3, and the last one was December of year 5. That's a 36-month period between these two dispositions. So this factor weighs in favor of ordinary income. All right, so far our tally, in terms of the questions, we've got 5 in favor of ordinary, and we have 2 in favor of capital. So far it's not looking very good. Again, we still might get the last ones. We might get 5-4. Let's see. So let's go to P. How many real property dispositions did the taxpayer undertake in the 5 years prior to the first disposition at issue? So in cases 3 and 4, again, case 3 and 4, capital treatment, the taxpayers had 1 and 6 dispositions at issue in the 5 years before the first disposition. However, in cases 1 and 2, the taxpayers had 29 and 46. Woo! What a huge difference. Again, cases 3 and 4, they were both capital treatment. Cases 1 and 2 were ordinary. So that's a huge difference. We see a pattern there. We see a pattern as, okay, there's a much bigger difference there. Let's see what the pattern is. What have the courts held? A pattern emerges where if the taxpayer had more dispositions in the 5 years before the first disposition, it increases the likelihood of being considered ordinary income. So 46 was actually in case 2, but the idea is that if it's more, the higher it is, the more likely, because the idea is that, again, it's more you're making more transactions, more likely to be a dealer or developer. Calvin had 50. 10 over the last 5 years before year 3. You're told in the facts that in year 1 and 2, he had 10 average sales. And then in the 3 years before, years 1 and 2, or year 1, I should say, he had 10 average sales. So that is 50. 10 per year, 5 years, 50 dispositions. So right there, this is even more than 46 dispositions. So this factor weighs the outcome as more likely ordinary income. All right, well, we're at the last question, and our tally is ordinary 6, capital 2. Not looking too good. Again, we still might get 6-3, and we might still conclude because maybe the last one is a super factor. We don't know, okay? Let's take a look. So Q, over the tax years in question, can the majority of the taxpayer's total income be attributed to the transactions at issue? In cases 1, 2, and 3, the taxpayer's dispositions at issue were a majority of the total income for the year. This was not true in case 4. Case 4, by the way, ruled ordinary. If the dispositions at issue make up a majority of the total income, then the courts have held that for this factor, the outcome is more likely ordinary. So if the answer is yes, it's more likely ordinary. Now, case 3 resulted in capital. Case 4, if I said ordinary, I meant capital earlier, sorry. Case 3 and 4 were capital, my apologies. And case 3 ended up saying yes to this question. The majority of the total income was from the dispositions at issue. Case 4 said no. So that shows that there's not really a pattern. So it's not really a strong factor, but it still lends itself that if the answer is yes, it's more likely to be ordinary income. More likely to be ordinary income. Well, Calvin received a majority of his income from the dispositions in years 3 and 5 from these transactions in year 3 and 5. In year 3, Calvin received a total amount of income of $1.5 million, and he received $1 million from the transaction at issue in year 5. In year 7, he received, in year 5, he received $7 million and $5 million from the transaction at issue in year 5. That's obviously more, those numbers, $5 million and $1 million, are more than half of the total income during the year. But again, this is more a limited factor, but still lends itself to being more ordinary. Okay, so looking at our factors, we've got ordinary 7, capital 2, and that does not look very good. That does not look very good. That's definitely lending itself more towards ordinary, and I would tend to agree. If you're going through factors and you say 7, 2, almost surely it's going to be ordinary. I mean, again, there's a chance that one of these factors could be a super factor. Now, one of the capital factors, we determined there was no pattern, so it could not be a super factor. That's what we said, okay? So there was another one that might be, but we know that one of them is not a super factor. Some of the ordinary factors, they were not super factors, but some of them, let's see if they are. Let's go ahead and let's now conclude. But so far, it looks like, hey, it's probably going to be ordinary because 7-2, right? 7-2. But let me explain what you would do if this was more like 5-4. This is more like 5-4. Let's go on to the next part. All right. Well, the ultimate answer, it depends upon the court's specific analysis. So what I'm saying is that, well, how we analyze, again, we're not in the mind of the judge or the jury in determining which factor is more important that day, right? They might wake up one day thinking one factor is more important than the other. There's strong support that suggests that in this situation, for Calvin, it lends more towards ordinary, right? Because of the 7-2 split, that's 7-2. I mean, that's really hard. Even if you had 2 super factors, you could still argue, well, there's 7 other factors out there. Now, again, only 2 of the 9 factors, or 9 questions, resulted in capital. And one of the 2 questions, question B, is much more limited. That's what I was saying when considering the facts of the 4 cases for the questions and no distinct pattern. Because remember, one of those cases was capital treatment, and one was ordinary. 2 of the cases are capital, right? One of them that was capital said yes, and one said no. Now, our answer was the single transaction versus multiple. The only case of the 4 that said multiple transactions was actually ended up being capital treatment in the end. So that suggests that there's no strong pattern there, And it's not like, oh, you have 2 on one side, 2 on the other, like some of the other factors. Okay. Further, so that's to say that, okay, one of those 2 question factors, one of those 2 question analyses, it's definitely not a super factor, because again, if it was, it might have made a much stronger difference, or much bigger difference with respect to those cases that we looked at. Further, the courts have held that frequency and substantiality of sales is the most important factor. That's the most important. You can find that in Suburban Realty, which again is a Fifth Circuit case. So frequency and substantiality of sales is most important, meaning super factors. Specifically, questions O and P deal with frequency and substantiality of sales. That's the question, how many months between your sales, and also how many sales did you have in the previous 5 years. So both of those, the answer, it weighed itself towards ordinary. And again, those are super factors. They're in here. So coupling that with a number where, okay, 7 to 2, and 2 of those are considered the super factors, I would say more likely than not, it's going to be treated as ordinary income. A court would hold this as ordinary income in that case. Just looking at the weight of the factors, the super factors and whatnot, and also looking at the patterns that might emerge when comparing and contrasting the different cases. So that's the best approach in a factors test. Again, is to find at least one case on both sides and kind of compare and contrast. I recommend at least 2 on both sides, like I did. But if you can't find 2 on both sides, definitely 1 and 1 of similar facts. Go through and make comparisons to like I did through each one, and go through the questions that make differences. And if you want to use a similar table, a similar approach, do that. If you're taking my class, that's going to help me understand what you're trying to communicate. It's all about showing your reasoning and showing patterns, where patterns come from, where they emerge, and also showing your logic. Now, I mentioned earlier that with characterization questions, again, capital and ordinary, they're the ultimate characters. And we went through the factors test, and we're going to determine, okay, more likely than not, it's going to be ordinary. So it does indeed meet that primarily for sale to customers in a trade or business, because it goes through these factors and it looks more like, hey, they sold these 2 pieces of land as a developer and their normal course of business as a developer, and it's part of that rather than just investment property. Again, we know the Midas touch doesn't taint everything, but it's hard to overcome that, especially here with these factors. So capital and ordinary are the 2 options. I mentioned that sometimes there's exceptions. There is one code section that could provide an exception to Calvin here. It's code section 1237. However, section 1237 is not available to Calvin. And the reason why is because he's a dealer, developer in real estate, and because he has subdivision activities within 5 years of sales. Within year 3 and 5, he actually did subdivisions. Year 1, he subdivided. So he can't get the section 1237. That would, if you were able to elect under section 1237, and again, he can't get it here, you could convert this ordinary to capital if you got that section. It's a special rule for dealer developers in certain cases. Congress laid that out because of issues like this, making it a little bit more clear and certainty. But Calvin can't do that because, again, he's a dealer developer and he has subdivision activities. So our conclusion, just very short, Calvin, more likely than not, must record an ordinary gain in year 3 and ordinary gain in year 5 on each respective disposition. So again, always important to use that more likely than not language, because when it comes to taxpayer positions, more likely than not is the standard, more than 50% in terms of taking a position and making sure you have a reasonable certainty, reasonable basis, and whatnot in that respect. All right, let's finish the last sentence. The ordinary gain in year 3 is $600,000, and we have to change that to $600,000, right? $1 million minus the $400,000 basis. And the ordinary gain in year 5 is $4.2 million, right? The $5 million minus the $800,000 basis, 4.2, it's recognized. Now, before we conclude, I want to talk about a few things. First, I mentioned in the presentation some stuff about artificial intelligence, AI. I have a video that deals with predicting tax outcomes using AI, predicting tax outcomes. And the idea is that it really depends on your audience and who is asking you to do this research, but you might be able to use AI to help guide your research, you might not. I'm a big fan of it. I think it helps a lot. It also materializes things. We looked at the percentage. When I actually put in the facts of our case, Calvin's case, into AI software, and I actually got a 61% chance that it's treated as ordinary, and I'll show you that, what it looks like, the output later on. But the idea is that this could be helpful, but just, again, keep in mind your audience and how you're using that. Another thing I want to mention is, in this, we looked at cases. This specific topic deals with, there's a lot of case law out there, but if you find things like revenue rulings can also be used the same as the cases, right? We did case 1, case 2, case 3, case 4, right? Case 1, we had the Suburban. Case 2, we had Graves. Case 3, we had Sugarland. And case 4, we had Connor. If you have a rev ruling that's binding on the taxpayer, which generally they are, as long as they're not superseded or overruled or whatnot, then revenue rulings, there's facts in them. That you can also use revenue rulings in the same regard as cases. So keep that in mind. It just how it happens that this specific issue, cases are what really matter. So I didn't really involve revenue rulings, but some topics where there are factors, you're going to deal with revenue rulings. Like if you're dealing with when and timing questions, there's some factors tests like all events test or constructive receipt of income, and there's revenue rulings out there. You can use revenue rulings. Anything with factual, with facts in them, you can use this type of factors analysis if it's a factors question. If it's bright line, you just want to go through the conditions and get them, go through and knock them out and explain the law for each one and explain your rules. But if it's a factors test where, it's not bright line, then you want to set the audience up to say, hey, here are 19 questions that help us with the important factors. I'm going to answer the questions for you for our case, and I'm going to show you 4 other cases. 2 went one way, 2 went the other way. I'm going to compare and contrast. At the end, you're going to have some idea. Hey, look, it's 7-2. 7 in favor of one direction, 2 in favor of the other. Now, again, it's not simply just majority wins. There's some factors that are stronger than others. There's patterns that emerge. I'm just going to point to you, and then I'm going to say at the end that, hey, I think that the 7 wins here because you've got majority, you've got more patterns on the 7 than the 2 don't have as many patterns. You've got some of the stronger factors are over here in the 7. So it just comes across as all regards to me that here it's ordinary because on the ordinary side, it makes more sense than the capital. There's arguments for capital here, but they're not going to win the argument overall, right? You might win certain factors, certain factor battles, but not the war. That's the idea. So keep that in mind. Okay, I want to go through some items in the that we're dealing with the artificial intelligence just to give you some idea of what I'm talking about. I first want to show you the output reports the AI does for those 4 cases. Then I want to show you our case, and I'm also going to talk about how I kind of played around some of the factors to kind of find out those super factors as well. So remember how I told you in the fact pattern or in the memo, I said that the courts, they have held that the frequency and substantiality of sales is most important factor, Suburban Realty. From that, I found that, and of course doing the research, looking in the cases, going through Checkpoint, going through CCH, going through Westlaw, Lexis, looking at the cases for super factors. I went through, and what I did was I played around with factors, and I changed around numbers for some of the factors. That's how I determined that questions O and P were the most important ones. And I'll explain my results looking at question P later on. Okay, let's go ahead and look at those reports now. So this is Suburban Realty Company versus United States. This is case number 1. This is the artificial intelligence software I use, and there's other artificial intelligence softwares out there, and there's ones being developed in the future. This is one that it gives you an idea of the facts of the case. So the Suburban Realty, it actually puts the facts in, and it would say, using its algorithm, what percentage is the predicted outcome. And it ruled 59% that it's considered ordinary, not a capital asset. Remember how this works. We have 50% here in the middle. The way it works is that it just goes up from 50%, and the middle is kind of like a coin flip, right? You're at a coin flip. So it starts at 50%. It doesn't go below that. So we're 90% from the middle. So we're only 9% from that level. So there's not strong confidence. I would say that in our memo, and I actually said this in our memo, I didn't read it to you, but there's many facts that even suggest that our case was even beyond Suburban Realty, especially looking at the some of the things like questions O and P, where you're looking at the number of transactions, right? Suburban Realty had like in the 20s, I think 29 in the last 5 years. And our case, Calvin had 50 in the last 5 years. So there's actually arguments that it should be even higher. And you're going to see later on that Calvin's case is actually higher. It's 61%. It's 61% non-capital asset, so it's even more. So this is Suburban. Let's take a look at another case. Here we have the Connor versus Commissioner of Internal Revenue case. This is case 4, 11th Circuit case. And remember, 50% are here in the middle. The predicted outcome by the AI software is 68% capital asset, court held capital asset. So I just want to show you that AI software can be used because we saw one side, right, case 1, we saw in the Suburban case, which remember was 59% not a capital asset, predicted by AI, as well as the court ruled not a capital asset. So you can just see how this AI can be useful. It can help guide you. And again, we ultimately concluded that our facts are most associated with Suburban, the closest to Suburban. If you go back and you look at the table and the conclusion that I had on that last page, the memo, but even beyond. So looking at that percentage, guess what's going to happen? You're going to see on the next page that it results when you put in your facts to the AI software, it's going to be even more likely that it's not a capital asset. Okay? Not a capital asset. So let's go ahead and take a look at that. So here's Calvin's facts input into the AI, and you see it's 61% not a capital asset. And the idea is I showed you cases 1 and 4. We didn't have to look at case 2 and 3. Case 1 and 4, right? We're in the middle here, 50%. Case 1 was right here. Case 4 was right here. So 1, 4. We actually made points that for some of the questions like O and P, we should actually go further out because, for example, case 1, the answer to question P, dealing with the number of transactions before 5 years was like 29. Well, for this one, the answer is 50. It's 50. So that's why things like that question, 61%. Now, there's some questions that were better than case 1 with respect to our case, but not many. So that's why it's an increase. It's not 59 like case 1. It's actually 61, which means it's more likely than case 1 to be not a capital asset. So that's how you can use kind of the AI. Another good use of AI to do these types of research. And again, if your supervisor does not want you to use this type of, put an AI into the memo because maybe they're a stickler for the code and whatnot, that's completely fine, but it can help you. We learned that in the Suburban case that certain factors are super factors dealing with substantiality and frequency. And I told you that specifically questions O and P. Specifically question P, what I did was Calvin had 50 sales transactions in the 5 previous years. What I did was I changed that. I said, what if I change it from 5 to 1? Because some of the other cases that were over here, cases 3 and 4, they had 1 or not many, maybe just a few. So when I changed it from 50 and I changed it to 1, guess what happened? It went from 61% to 53% not a capital asset. There was an 8% change. That's huge. When you think about 19 factors, 19 factors. We're not just now focusing on the 9 factors, 19. That is considered a super factor. If you go from 50 to 1, that is a super factor. So this is considered a super factor P for our case. And you can kind of see how it can be kind of a sliding because it's not just a yes or no question. It's okay, how many transactions did you gauge in the last 5 years? Some people were, in the high 40s, some were 20s, some were 1 in the, single digits. As you can see, if you put 1,000, obviously that can make a big difference as well. The idea is that 50 is a lot much more than 1, a bigger multiplier exponentially at some point. So, that change of 8%. So if we put 1 in for P, not 50, which the lower the number is, the more likely it's capital, we'd be at 53%, not 61%. That's how big of a difference. That's how big of a difference this is. Okay, and that's how this AI software, whether it's the one you see here or any AI software you use in the future, because it's going to be all over the place in the future, it can really help you do research. All right, so that's really everything for the memo. The last thing that I want to do is I want to talk about some other examples of factors tests in case you're in my tax research class, or maybe you're taking another tax research class, or you're in practice, and kind of like I mentioned earlier, the 5 questions of tax. That's how I like to talk about things. Well, in my previous tax video, I did a deduction. In my previous memo writing video, I did a deduction, a medical expenses question. This was a characterization question. You can use these types of memo to help guide you in structure. I also want to provide some other factors tests to give you an idea of how to structure other respective topics. So let's go ahead and take a look at that. So the first one I want to talk about is defining a trade or business. As many of you know, in the tax law, there's three activities. There's the big three. I like to call them the big three. The big three are the activities. Activities are trade or business, investment, and personal activities. And the idea is that you generally want to be trade or business. And the reason why you want to be personal use, or I call it personal use because I don't like to confuse personal property with personal use. Personal use, the general rule is that for deductions, general rule is that you can't take them unless there's a specific rule in the tax law, like real property taxes or mortgage interest or medical expenses, things like that. Trade or business is on the opposite end. Generally speaking, you can take the trade or business deductions, but there's limitations on that. And then investment is kind of like trade or business. It's somewhere in the middle, but there's much more limitation than trade or business. So the idea is that you prefer trade or business activity over the other two because you get to take more tax benefits, more tax deductions than you could in the other two. Investment, a lot of times you're going to be limited to the income you receive. So if you are an investment rental property, you're an investor in a rental property, and you have all these different rental expenses, you're limited to the amount of rental income. You can carry that forward, but you're limited to the amount of investment income you receive. Personal use, you just lose it, okay? Unless, again, it's allowed under the law. So trade or business. What determines if something is trade or business? This is a factors test. A lot of the questions here deal with deduction because, again, we're focusing on deduction. So anytime you have a deduction issue, trade or business. Now, Section 162 is the general trade or business deduction rule. So if you're ever dealing with trade or business, make sure you go to Section 162 and you cite that and you talk about Section 162. Very important. But there's some questions here. If you want to pause the video, you can look through these. The idea is that when you're doing a factors test memo, you just don't go into the factors. You still have to go through the setup of the law. You have to start with Section 162 and explain why trade or business matters to your taxpayer, because it might not make a difference. For your taxpayer, it might not make much of a difference because they might still get the benefit. But you should set that out. You should start off with a code like you always do, Section 162. Now, Section 162, and by the way, go ahead and stop the video. I have videos on Section 162, trade or business expense, general trade or business expense. If you want to watch them, they're on my videos. But the idea here is that there's different propositions you have to prove. And you need to go through those requirements if you're dealing with a Section 162 issue. Now, you're going to find there's ordinary, necessary, expense, incurred, during the taxable year, so during the year, in carrying on a trade or business. So if you look at Section 162 and you read the code section, you're going to see it actually states those provisions. And you might be wondering, why am I saying conditions? You have to meet all these conditions. And these have been established as conditions by the Supreme Court in various cases. And there's thousands of cases that deal with these issues. Ordinary, necessary, they actually have their own factors tests. These two together, okay? That's very important to consider because if you're looking for specific issues, ordinary, necessary, they have their own factors test. But defining what an expense is versus capital expenditure. Talking about incurred deals with the method of accounting. Are you a cash versus accrual method? During the year, okay, well, that's pretty self-evident. Okay, are you a fiscal year, calendar year? In carrying on, if you're not an existing business and you're starting to research a business, that becomes an issue. Also, Section 195 might come into play for those issues where you have startup expenditures. Trade or business, that's what we're talking about here. We're defining trade or business. The definition of trade or business, it goes into these factors. Now, there's going to be times where it's clear that you're a trade or business. If you're a corporation doing business or an LLC doing business and a business entity, it's very likely you're going to be a trade or business. There's times where you're not. You might be investment activity, or different owners might not be considered in the trade or business of that. But there's other times where it's not as clear, like horse racing, or usually it's things where there's elements of personal activity like horses, you have like personal interests or amusement, things like that. So if you do have an issue, the idea is you still got to start with the basic rules. So if you're dealing with a taxpayer, you have to say, okay, well, section 162 is important for these reasons. You have to lay out all of the different conditions and go through those conditions and meet them. And then say, oh, well, the issue here is trade or business, or the issue here is ordinary necessary, but you still go through all the conditions. Because to get section 162, general trade or business, you got to meet all these. You have to meet ordinary, necessary, expense, incurred during the year in carrying on a trade or business. If you skip any of those, then if you're taking a tax research class or a supervisor, they assume that like, okay, well, either you don't understand that those conditions are required and they have, you have to go through that analysis because there's hundreds of cases, or they just assume that you automatically just know everything you're talking about, and that's not good. That's not good in practice. So you need to go through all of these. If you're in my tax research class, you need to go through all these conditions. And that's for any rule. I'm just trying to stress here that even if you know, hey, a fact pattern is trade or business, you still got to start with the basics. Just like in the characterization video you saw here with this memo, I started off talking about section 1001 and calculating realized gain or loss. And what is amount realized? What is adjusted basis? You have to go through and you have to define all these things. So you would go through all these different terms, ordinary, necessary, expense, incurred during the year in carrying on a trade or business, and you would explain them and what they mean using case law or using the code or using regulations, and you would explain, given the facts, but you would go through all of these. You could think of these requirements not like factors because they're conditions, but once you get to trade or business, there's a factors test there that if it's not clear, you would have to go through and determine. If it's not clear, if it's clear, you don't go through the factors. Again, example, if you're a business entity, most surely you're probably a trade or business. Not always, but most surely. Again, it only gets into issues when it's a little bit stickier. All right, let's go on to the next one. Okay, so now we're talking about the when question. Remember there's the 5 general questions of tax? The when question. So the when question deals with when do you have gross income or when do you have deductions? Constructive receipt of income. So we're talking about income, we're talking about inflows. The idea here deals with methods of accounting. You've got the cash method versus the accrual method. And the idea is that there are times where taxpayers try to say, hey, I don't want to record, give me the check next year because I don't want to have to record the income. That's what the constructive receipt of income method deals, or that issue deals with. And there's factors involved with whether it's determined, okay, whether you actually meet it or not, whether it actually applies. Constructive receipt of income is a doctrine, whether it actually applies. Because as you know, in the cash method of tax and accounting, you record revenue when you receive the cash or checks or whatever, credit card payment. You record expenses when you pay the cash. Accrual method, you record expenses when you incur the expense, and you record income when you've earned the services or the work or whatnot, or you've performed the sale or whatnot. So you record it then, not when you actually receive the cash. So this deals more with the cash method of determining when you have income. You go through this in the 400s, starting with the 440s until the end of the 400s. There are some code sections out there that deal with timing. So constructive receipt of income, you're going to find code sections that deal with timing there. There's also regulations as well, regs. So starting in the 440s all the way to the end of the 400s. So it might be in 440s, it might be 450s, 460s. Those are the main areas when it comes to timing, the timing issues, the when questions of tax. But there are code sections. Again, you need to start off with the code sections and the regulations. Always start with a code. Then if you get to a constructive receipt of income issue, then you lay out these factors. Go through the cases like I did. Find some cases that are similar like we did in our example, and you want to compare and contrast the 2 or 4 cases or whatever it is. Here's another when question. This one deals with expenses though. This is the all events test. All events test can apply both income and expenses. So when question, when do we have expenses? All events, certain requirements, all events. Usually deals with the accrual method. And the idea here again, look in the 440s to the end of the 400s. That's where you find the timing code sections. You want to start with the specific code section that applies. There's also regulations in this area. So you want to use the code, the regs, you want to start off there, then you want to get down to how this factor, how it actually works, and then you want to start going through the factors using cases, rev rulings, whatever you have. And you want to compare and contrast your facts to the cases, and you want to make differences. Use that chart if you want, okay? And by the way, there's some hints here of where you might be able to find those code sections. You see that one there. There might have been a hint or two in the last few factors tests as well if you want to go back to those videos. But the idea is that go back, look at the memo that I went through with you, right? This memo on Calvin's facts. And you'll see that it was a logical progression. We started from macro, just talking about calculation of gain, then recognition of gain, then characterization of gain, and then we got down to the specific and we said, hey, the ultimate issue here, the main issue here is characterization, and it's even further down. We eliminated, hey, it can't be 1231. It's got to be whether it's a capital asset or not a capital asset. So then we went to capital asset and we said, well, there's only one specific exception that I can apply, and that was the primarily in sale to customers in the ordinary course of or in the trade or business. So we determined, okay, well, it might apply, it might not. So we have to determine, that's where we brought in all this case law. And we then determined, well, we have trade or business, but the primarily for sale to customers is really the issue. From there, we've gotten the factors test, boom, we went right to the Suburban case, we went right to the Winthrop case, we've got those factors, and looking at various cases that apply the factors, they looked at various factual findings, 19 questions, and from there, that's where you see like these questions as well. So what I'm saying is that you don't want to just start right into the factors. You want to lead me why the factors, how you got there. That the leading part is just as important as going through the factors itself in a factors memo. So make sure you do that. So there are code sections for this one, for the when questions, timing, those things as well, and there's regulations. Definitely start there and then lead yourself down. All right, I've got two more factors tests. This factors test, actually, there's not really any code sections that deal with this one. There's not really any code sections. And some issues, you just don't have any code sections that really apply. It's an area of the law, it's all case law or rev rulings. Which is you're looking at a specific taxpayer. Are they considered an employee or independent contractor of the hirer? So is the worker considered an independent contractor or an employee of the hirer? And you go through these things. This is an area where there's not really any code sections, but you at least want to start off your memo explaining why it matters and how you got to these factors. For example, I might give a section 199A qualified business income deduction problem or fact pattern where you're doing research for the employer, or sorry, I shouldn't say the employer, right? I should say the hirer, right? That's the key language is hirer because we don't know yet. And they're trying to determine if their worker is an employee or independent contractor because they need to know whether what they pay them is considered wages for the wages limitation for 199A. So stuff like that. So you would start off with the code sections that make the difference. So there's not really any code sections that deal specifically with employer versus independent contractor, that analysis. That's all found in the law, in case law. But you need to start off by discussing code sections and regs of why it matters in your fact pattern. Of why it matters in your fact pattern. So again, I gave the example of section 199A. So you would go through the code section 199A. And by the way, if you're watching this in the video and section 199A is no longer there, it's something from the past. And it's an example because you might still need to do it in past times or look at that. If section 199A, there's a wage limitation potentially that might apply where you're subject to 50% of wages or 25% of wages, and you're paying, the hirer is paying a worker, and they want to know, hey, is this person an employee or independent contractor for purposes of federal tax law? So you would start off with 199A and work your way down, starting again macro down to micro. So that's when I first supervised tax professionals doing tax research. That's the biggest issue I find when it comes to doing research in the factors context. They like to jump right to the factors, but you need to explain to me how you got to the factors, because I might disagree. I might say that I don't think that's really an issue. Going down that line, you just wasted an entire factors analysis. I think we can overcome that factors test by going this route. So that's the idea. All right. Here's the last one. Unrelated business taxable income. This is a specific area of the law. It deals with in the 500s, check the early 500s, like check 500 to 530, and you've got tax exempt orgs. Now, there's a specific topic that, as many of you know, certain entities, tax exempt orgs, are not taxed under the federal tax law. However, if they conduct what's known as unrelated business taxable income, then they are going to be taxed on that unrelated business taxable income, also known as UBTI. So if you have a UBTI fact pattern, again, there's a factors test that is going to apply. You got to go through the cases and whatnot, but it's important to understand you still want to start off. You want to explain the code sections of why they're considered tax exempt. So you want to go to 501 and start there. If you're told in the fact pattern that they're a 501c3 or 501c4 or 501c2, you still put that in the facts and you explain, hey, this person is exempt because they're this type of taxpayer. They're 501c3. Then you lead through and you keep going down to the code sections, and there will be code sections in the 500s that apply. And finally, you get to the language where the factors test comes into play. So from our memo, the language that was important where the factors came in was primarily for sale to customers. So if you're dealing with UBTI, there might be something in those 500 code sections dealing with unrelated business taxable income. I'm not going to give away too much. And the idea is that there's a phrase that's key and the factors come into play there. So I'm not giving you that. You need to lead me down to that and explain, hey, I got from 501 to this 500 section to this 500 section, and then we're going through the conditions. Oh, see here, this primarily for sale to customers, that's what that issue. That just like we had in our memo today. That's not in the 500s, by the way, but I'm just giving you an example. That's what we were trying to find when we were looking at the primarily for sale to customers language in the memo today with Calvin. The idea was we got all the way down to, okay, we're a trader business, but the other part of it is primarily for sale to customers. The factors are what determine whether we meet primarily for sale to customers when we're a developer and we have land sales. So we went through all those questions, all that analysis. So the idea is that you got to actually get to the factors. I'm showing you what some of these factors tests are, which you can stop the video, take note of these things. But the idea is that you also have to guide me in a memo down to the factors. Get me all the way down there. And then eventually you will end up at a factors test. So it's not just, if you're taking my tax research class, or you're taking another professor's tax research class, or you're in practice, it's not just about immediately jumping out of the factors test and saying, okay, here's the issue, it's a factors test. You got to go through, walk through the steps. Again, take the memo that we went through today as a perfect example. We start off, basic steps, section 1001, foundations of all property transactions, realized gain or loss. Then we calculate the realized gain or loss. Then we said recognized gain or loss. Okay, we know, okay, it's recognized. Okay, now we know it's recognized. Now we have to determine the characterization. Okay, we say, okay, well, there's ultimately two types of character. There's ordinary and capital. If we define ordinary as this and capital as this, and they're in line, then let's isolate what's important. We saw that you need a sale or exchange. Well, we have a sale. Boom, that's done. So now we need to determine if we have a section 1231 asset or a capital asset, because that's what was laid out in section 64 and also section 1222. Not section 1231, so therefore we have to go to the next part. Is it a capital asset? We go through capital asset. Everything's a capital asset except for what's in the list. We go through the list. The only thing that possibly applies is primarily for sale to customers and trader business. We determine we're trader business, but what about primarily for sale? Well, there's a lot of facts that we have that could go both ways. So we go to the factors test, and that's where Suburban, that case, and Winthrop come in, and it says, okay, well, we have factors that determine whether primarily for sale to customers in the 5th Circuit, which applies the 11th Circuit, also applied the 4th Circuit, and the idea is that we go through these factors and we weigh. We weigh the decisions, and then ultimately we determine, hey, we are primarily for sale to customers because the factors weigh in favor of it being treated as ordinary, and we conclude it. Section 1237 did not apply, and that's a special rule. And again, the conclusion was that the gains that we calculated were considered ordinary gains. And that's everything. That is, in a nutshell, what we did today in this presentation. Go back over this. Extremely important. Go back over the artificial intelligence portion in my other videos that I mentioned in this video. Go over the factors test that I showed you. There's many more, many hundreds of other tax issues out there that have factors tests. Determining debt versus equity, lots of timing. The who question with looking at assignment of income. There's so many different factors tests out there. I can't go through all of them. I tried to give you an idea of some of the main structured ones. I went through some timing questions. I went through some deduction questions like trade or business. I went through some special things like worker classification because that's a very common one. I also went through unrelated business taxable income because it's a special area. All right, so with that, I hope you enjoyed this. I know this is a long one, but very, very important for practice, very important for my students, very important for anybody. Anyone that's a tax professional, you need to know this stuff. Very, very important. So I hope to see you in the next video.